Do, 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 do. What up, what up, what up? What up, what up? What up, everyone? Welcome back to Financial Education and Business. So today I'm going to be covering what the heck is going on out here in the market. Why did the market just out of nowhere recover today? Did we even get anything new? Or was there just like a major squeeze that's pulling the market to the upside? Overall, I really didn't see anything that was new that would kind of drive this market up to the upside. But maybe a lot of investors are thinking we're in an oversold position. But it is a little confusing. Why the heck is the market running today? But we're just gonna go look, see what's going on, and then we're just gonna do some research together, find out what it is, and then we're gonna cover Fluence. Fluence Energy reported earnings today, earlier this morning. Pretty decent numbers. Backlog looks really good, over like $5 billion of backlog, and so strong company. They are still growing, not slowing down. As you know, Fluence is a company that is run by, they have partnership with Siemens. I believe they used to be part of Siemens, and then they rotated out and became their own company. So we will look at that, but let's look at what's going on in the marketplace real quick, and then we will kind of go from there. We're gonna start at what happened. Look at the overview, and then I'll continue from there. So let me see. So it looks like Nasdaq and S&P lead tech rally. So the Nasdaq 100 surged 2.6 and the S&P surged 1.6 today, marking a strong day since May. Optimism about the potential December Fed rate cut and tech rebound led Alphabet, Tesla power gains. AI stock and Alphabet shine amid rebound. So Alphabet jumped because they launched their Gemini 3 AI. Continued strong monetization, with tech sector broadly recovering pretty well today. As you can see, Nasdaq up 2.71 for the day, the S&P 1.56, the Dow 0.45, and then you have the VIX that's finally down because it was significantly up there. So there's a potential now. The probabilities have changed. So probability of Fed cut in December has gone up now. It was like 50 when I saw it last. It looks like right now it's roughly around that 67%. So it's kind of just floating all over the place. So target rate probabilities, as you can see here, CME FedWatch tool forecast rate movement based on Fed fund futures and trading data. So we got 3.5 to 3.5, 3.75. We're here sitting at about 67%. 3.7 for 4 to 4. We're up at about 32.7. So according to the CME FedWatch tool, as of today, there is about 67.3 probability that the Federal Reserve will cut interest rate by 0.75 basis points upcoming meeting. Upcoming U.S. Fed Reserve meeting date. So the FOMC meeting regularly to set the Fed Reserve interest rate policy, impacting borrowing costs, inflation, so on and so forth. U.S. Fed interest rate exemptions expectations in 2025. According to the CME Fed Watch List 2025, there is about 67% probability there is the 67 probability that the Fed rate will be anywhere between 3.5 to 3.75%. And here are the probabilities. A lot of this looks like it's AI generated, so it's kind of all over the place. But so that you can see the probabilities kind of all over the place. And we are not any more clear today than we were in the past. So I don't know, that can be one of the reasons really that the market rallied. What made the stock market rally today? So according to kind of what happened, this is going to consolidate everything. Today's stock market rally was driven by rising expectations of the Federal Reserve interest rate cut in December and a strong gains from major technology companies like Google. Main drivers: investors believe that the Fed is going to cut rates. The Mag 7, the mega cap technology companies went up. Google going up 7%, Nvidia 2%, Tesla 6.82%, sharp rise over 7%. Today, boosted by an analyst recommendation, and so news around AI. Other tech names such as like Broadcom and Meta also came back as well. The Nasdaq Composite 2.67 today, climbing about 2.7, the largest single day gain since May. So when you see these kinds of jumps, it's kind of like a squeeze where you have a whole bunch of people thinking the market's going to keep going down, and then they get caught up because then the market is going to flip. It's going to flip and go the other way. Additional context: the start of the holiday shortened Thanksgiving week encourages active positioning in equities, supported by prospect of low interest rate and rebound for recent market volatility. Bitcoin up 1.82%, also saw a gain, helping boost the rise in sentiment across this asset class. The problem is right now, yes, we're going into the holidays, Thanksgiving, people are going to go shopping for Christmas, all this, but the overall situation didn't get any better. AI is still the only thing that's propping up the market, for one, in reality, and then two, the only thing that's really propping up the market, if it is AI, then it's dead, because a lot of AI right now is being backed by debt, and that's just the way the cookie crumbles. When you look at what OpenAI is doing and all the partnerships, it's all around debt and maybe future expectations of what the business partnerships they're going to do as business partners. Additional context, though, you got Thanksgiving, encouraging spending, Bitcoin, upcoming key economic reports, Yahoo, stock market, Dow, FSB, Spark, major tech sectors going up, which Fed coming to move. So it looks like mostly just like a rebound. Literally, it's just the stock market was beat up, and it looks like investors are wanting to just make it go the other way because it really was beat up. Specifically, when you think about it, nothing new has come up from where the stock market was about in Halloween. In reality, the only rumor that really started to compound on itself was around the AI bubble and private credit. And so if private credit gets hit in any significant way, this market is going to tumble even way more than it is right now. So this is why you either got to manage like your portfolio. Are you going to go leverage, or are you going to go or are you going to kind of hedge? Oh, I'm tired today. Hedge the market, and hedge the market in a way where it would kind of, you would benefit whether it goes down, up or down. From an earnings perspective, a couple companies did release their earnings, and they're not anything large at all. Yesterday, like today, was Zoom. You got Zoom, you got Fluence Energy, and you got the Symbiotic reported, and like none of these companies are not that big, are not really going to move the market very much. But tomorrow it's going to be a very important day, just because you got Dell, HP, you got Clean Spark, you got Wednesday, Workday, my bad, Workday, HP, and you got Autodesk, and Neo, you got Alibaba, and then you're gonna be able to see, retail sales, how that's going in the retail world. So maybe there's something going on there, and so that definitely is not going to drive. This can definitely drive the market tomorrow, up or down. But there's going to be a lot of eyes on Alibaba and what they're going to say tomorrow. If they, it's hard to believe the numbers they put on, but there's going to be a big impact tomorrow. But Fluence is one of my favorite companies that I like to look at. They reported earnings, as you can see. They did their earning call early this morning at 8:30 a.m. Obviously, I didn't join. But if we look at what they reported and we look at their earning numbers, they didn't beat again. So when you look at this, they always miss expectations. Not always, but most of the time. I mean, they've beat it here. There's moments where they missed it. They missed it last quarter, the quarter before, the quarter before, the quarter. Going back almost all the way to Q3 of 2024, they've always missed earnings. But it looks like they also missed again, and the market, despite that, still rewarded them, up 8.12% after market close. Um, and then the last thing, I'll cover this in depth a little bit more. EPS, they didn't beat again. As you can see, it's not in their, they don't, it's not something that they always do. But they gave some good guidance, and then so that's why the market kind of rewarded them today. 2% on the day, almost 3, then another 8% after the market. So overall, about almost 11% for the full day. Um, crypto has rallied today significantly. Bitcoin's back over 92,000, almost 93. Ethereum's over 4,000, almost, it was over 3,000. Going back down now. Bitcoin was at 88. It was way above 88 a while back. It went as high as 89, almost hitting 90,000, and looks like it's kind of breathing overall. But on the day, the market had a good overall day. XRP really showing significant growth above all the other ones, besides Zcash. Obviously, Zcash had a really good day today. Oh, not Zcash. I think this is still updating. Hyperliquid 7. Yeah, so yeah, XRP had one of the best days, as you can see, like in the market compared to all of the other cryptos out there. In the fear and greed index, when it comes to crypto, we are still sitting at 12. Yesterday we were at 10. As you can see, we really were down there at 10 just yesterday, meaning Friday. Last week we're at 17. We were at 17. The market usually when it, historically when the all-time, this is like from 2023 on September 2023. When you look historically, I mean these are very very low numbers. As you can see, this is where the euphoria was. This chart right there is Bitcoin, the gray one. Kind of shows you where is Bitcoin and where is the fear and greed index. So here, as you can see, the fear and greed index is way up here. We're looking at an 88 fear and greed index. Bitcoin is kind of topped right after that fear and greed index, and then it just kind of continued to drop. There was a little peak, but overall the fear and greed index continued to dump. And at this point it becomes fear below 20, and investors were kind of picking up Bitcoin again, and then we rallied. We never got back all the way to the fear extreme greed at all. But however, we started to dump again, as you can see, as the fear and greed index goes up, there's a peak, Bitcoin starts to peak, and then we started to just go down significantly. That's zoomed out very far. If we go in the past 30 days or maybe even like 1 year, this is what we see. You can see there's some moments where the fear and greed is way above, the actual share, the actual price of Bitcoin. Here it is. This is Bitcoin price. This is the fear and greed index. It load here, it went to as low as 10, and then we are back at 12, and Bitcoin is starting to rally as well. So we're at 12 still, not out of the fear. Fear is 20. Anything below that, it becomes like extreme fear. The stock market, obviously, right now is greedy. CNN stock market. We can look at the free fear and greed index here, and it's gonna probably show us some kind of greed here. Out of maybe 12, maybe not 12. Let's see. Fear and greed. So we're sitting at 14, so still within that extreme fear. Market momentum, so as you can see, seven fear and greed indicators. S&P 500 and 125-day moving average. S&P down, up, but then we just almost bounced off. We just bounced off of this almost 6,000, and we are still in fear. Stock price strength, it looks like there's still significant amount of fear in the equity markets. Net new 52-week high and lower in New York Stock Exchange. Put to call. So as you can see, the higher this number goes, the more fearful people are, because they are buying more puts versus calls. So 1 to 1. If the market ever hits 1, it's time to really get aggressive with your buys, because it is rare that we hit 1, continue to go up, and then remain at 1 for a long time. This is obviously when the stock market dumped during the tariff drama. So that definitely caused a lot of fear and greed. We're starting to climb again. It's at 0.8 fear and greed index. Options are contracts that give investors the right, but not the application index. Puts are the up. When the ratio of puts to call ratio rise, it's usually a sign investors are growing more nervous. A ratio above 1 is considered bearish. The fear and greed index uses bearish options ratio as a signal of fear and greed. The VIX was up a lot today, and once again, this is the April VIX. The higher the VIX goes, the lower the stock market goes, and so here's the fear and greed index. Here we kind of broke the the VIX broke above the 50-day moving average. So fear is coming into the market. So if you were looking at this, end of September, you started to see this flipping. You might say, "Oh, maybe I should get out." But it's hard to time it, because you never know what else can move the market that day or the week before, what kind of results the president but you never know what the president's going to release, and then the market's going to start rallying, because the market can stay liquid, whatever, crazy longer. What's the saying? The market can stay crazy longer than you can stay solvent, or something like that. So yeah, so here we are at 14 right now, which is extreme fear. Let's watch this video. This is me, Kevin. He's just covering, where are we in the market right now. Everybody's bullish, the market is running up, but in reality, did anything change that should receive the stock market to rally today?
Holy smokes, are we back? And is it time to buy the dip? In this video, we're gonna go through exactly whether or not we are back and whether or not it is time to buy the dip. Spoiler alert, every single dip this year has been a buy the dip opportunity. I kid you not. Liberation over here, and I remember, see this double dip right here at the end of April? I made videos going, folks, set trailing stops. Don't be dumping right now because we might be about to rocket ship up, and trailing stops would be the perfect way because you'll never get stopped out if you're on this kind of run. And the people at the time are like, Kevin, you're just making videos to try to hedge your bets and cover both sides. Like, no, here's the evidence as to why we're saying this, okay? That was then. You can watch the videos, they're there. But take a look at this. Every single dip has been bought so far. So the dip we had at the end of July, super minor. The dip we had in September, super minor. The October dip, super minor. This November dip has been a little bit more frustrating because it's been about 3 weeks. You know, we're about 3 weeks of like down. Right before Halloween, we hit all-time highs right before Halloween, and then it's been down, 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 down. Why has it been down? It's been fear because of the AI bubble. It's been fear because of private credit and liquidity stress. And these are all reasonable fears. In fact, I have to say the thing that makes me the most nervous right now is what I'm seeing with AI spending in the bond market. In fact, take a look at this chart right here. This chart is disgusting. So this is a pretty busy chart because I wrote all over it. I apologize. Just ignore the text for a moment. Look at the little red lines. So the red lines show you bond issuance, okay? So on the left side over here, I have 20. So $20 billion of bond issuance. And you can see it's kind of rare, you know, after 2020 that you see these lines, but they pop up. This arrow right here shows you the ChatGPT moment. And you basically had no debt financing for over a year after that ChatGPT moment. And then in 2024, like the second half of 2024, you started seeing, you know, a couple $20 billion deals, 20 billion, maybe a $12 billion deal, a little bit at the beginning of 2025, right? But now what are we seeing over here? Every month, boom, boom, boom. And you total it up, it's actually $88 billion of debt financing on the right side. So it's no surprise that you're seeing credit default swaps get more expensive for Meta and Oracle because people are like, man, dude, we're all of a sudden taking on a whole lot more debt than we used to. Because any single one of these lines on the right is more debt financing for AI than we've had at any of these other lines on the left. Maybe with the exception of just that one right there. But basically, you've got 3 of these sandwiched in a row on the right side, and it's really indicative of, whoa, why all of a sudden are we taking on so much debt? So I wrote a few notes here. I wrote, right now, we're at the phase of the economy where as long as debt issuance continues, we can keep this growth going. And that's good and it's bad. It's good because it means for right now, it doesn't necessarily mean we have to roll over. It just means like, hey, like, that's a whole lot of debt. I mean, I think Bucko over here, literally Bucko Capital Bloke, writes, David's saying the quiet part out loud. This administration has made some catastrophically bad economic decisions, and he's right. They backed themselves into a corner and cannot afford to go backwards on AI. This is in response to a David Sachs tweet, which says, according to today's Wall Street Journal, AI-related investment accounts for half of GDP growth. A reversal would risk recession. We cannot afford to go backwards. Full article. In other words, if we stop seeing this AI spending, we could end up seeing a recession right here. A reversal could risk a recession. Okay, great.
There's something cool here. What you're looking at is the new Speediance home gym. This one is called the Gym.
But if we're relying on AI for not going into a recession, then what we're really saying is we're relying on debt. Because in the last 3 months, all of this AI boom has been funded by debt. And that's really scary because Ray Dalio put it really well. He did this like 10-minute segment with CNBC. I'm gonna save you the time, okay? Basically, the last like 30 seconds are all that matters. And he's like, well, you know, yeah, we're definitely in a bubble, but you know what it takes to make a bubble pop? You gotta prick it. And you know what pricks the bubble pop? People dashing for cash. I can't do a Ray Dalio accent, but basically when people need cash, that's when the bubble pops. Okay, well, when is that? Nobody knows. But what we know is what I wrote on this chart, which is that debt issuance is going extreme right now. That's not necessarily to say it's going to stop, but we're starting to see that nervousness, right? We're seeing that nervousness with Blue Owl. Blue Owl's like freaking out. Look at what's happening with the private credit companies. Blue Owl backed the $30 billion Meta deal, which I thought was brilliant. Like, if you want exposure to the AI, boom, with getting a good valuation, in my opinion, Meta's at a good valuation, and you don't want as much of the debt risk, Meta's really interesting because they just financed a $30 billion deal where they have the opportunity to cancel their leases every 4 years and pay like a nominal early termination fee. Guess who holds the bag? Blue Owl. Guess out of these private credit funds, which is performing the worst? Blue Owl. It's down like almost half. Its stock has almost halved in value. The only thing that's doing slightly worse than Blue Owl in the private credit space right now is, Grindr. Grindr, I guess Grindr's not really in the private credit space, but what I should say is what is doing worse than Blue Owl is Grindr. Grindr has probably the smallest PP right now.
Little PP.
And that's because their executives are literally getting margin called because they leveraged up their own personal shares. And so their personal shares are getting revoked, they're getting seized, and they're getting liquidated. So who knows, maybe there's an opportunity to buy the shrink on Grindr, but that's probably a topic for a different video, maybe even a different channel. That's like only Meet Kevin or something. But anyway, I mean, private credit's obviously an issue, right? We see the Tricolor collapses right here. We actually topped after the Tricolor collapse. First Brands collapses here. The Crypto 1010 liquidation is here. And then, of course, we have multiple other liquidations following that. Now, of course, the CEOs and the executives of these companies, they don't want you to think that there are any kind of issues or cockroaches. In fact, you literally have the Blue Owl CEO saying, quote, "The point being, like, somehow, by just talking about this enough, people have worked themselves into this imaginary world where there's some bigger potential credit problem." That's what the CEO is saying. And then, of course, you have a list of all these companies like collapsing in private credit. And I kind of think it's disingenuous because it's every single time people go, guys, everything is fine. You should know that everything is not fine. It's almost every single time. Like, go into, on this list, you have the Sonder Hotel bankruptcy, right? Well, here is the Sonder Hotel bankruptcy piece in the Wall Street Journal, front page of the Wall Street Journal today. And in it, they literally do, where was it? It was an all hands meeting. Anyway, they talk about doing this all hands on deck meeting. Here it is. Employees were summoned to an all hands meeting. Managers expressed optimism that Sonder would soon be on solid ground. In other words, guys, everything is fine. Literally, look at this. Look at this. There's nothing to worry about, says Nick, Sonder Regional Vice President, said during the meeting. We just have to let everybody know that there are some problems, but don't worry. Everything is fine. What happens 9 days later? They go bankrupt. Every single time. It's like you got a company going, guys, don't withdraw your money. Everything's okay. Bankrupt within a couple weeks after that. It's like the kiss of death. It's almost like saying everything is fine is the kiss of death itself. I don't know. That could be like causation without correlation. But anyway, the point is everything is not fine. Like, there actually are private credit issues. And yes, our GDP without artificial intelligence would probably be in a recession. And what is propping up artificial intelligence right now? Debt. Okay, now, we're going to keep talking about that. But first, I want to talk to you about this bounce that we had today. Because the bounce today, I think, is heavily driven by an unwinding of a massive amount of shorts that we saw go into triple leveraged options and position taking on SQQQs. So the SQQQs are the triple leveraged short for the QQQ index. And volumes or flows into the SQQQs on Thursday were massive, absolutely massive, like $12 billion of volume into this. That those buys had to get unwound today. And there was actually a really bullish signal this morning. Well, there were two really bullish signals this morning that suggested today could be a green day. The first really bullish signal was Jim Cramer going bearish. 9 hours ago, Jim Cramer said there's no reason futures should be higher. This is the curse of the bulls. And then I'm like, all right, that's a bullish catalyst right there.
Bullish catalyst.
This is why I call Jim Cramer Kim Cramer. It's like Karen Cramer. Kim Cramer cast doubt, most bullish catalyst you could ask for. But there was something else. Yes, and this is not a pitch. This is to teach you. In the Alpha report this morning, I said, look, today is a test for the market, okay? The test for the market today is, can we hold 595 and can we get to 607? These are copy and paste lines from the Alpha report. And I want you to see what was in today's Alpha report. Look what I wrote. Thursday, Bitcoin drops before a big dump. Friday, Bitcoin starts lower and the Qs head lower. Today, Bitcoin is $2,000 higher than where it was on Friday. Think about that. It was the first time we actually saw Bitcoin higher. Usually Bitcoin was leading the market lower over the last few weeks. Last 3 weeks, almost certainly, Bitcoin's almost always been lower, 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 lower. And then the Qs go lower. And so I literally wrote, hopefully, this is a test, essentially, for positivity for the Qs today. If I had any guess today, Bitcoin starting up 2K versus Friday is a great sign. So fingers crossed, the Qs rally and gets to 607. That would be a good sign of strength and reiterates buy the dip. Folks, don't look at the Qs today and look at the numbers.
This credit card has an interest rate that's really, really low. How low? This low. The credit card that's in your wallet.
Okay, let's look at the Qs and look at the numbers. You can't make this SH9T up, boys and girls. From 595, literally, from 595, you rocket ship. And look at where we ended today. We ended right here. We had a high of 606.68. Look at that. That's the 607 line right there. Look how close. It's not 100% perfect. That would be like crystal ball. But I have to say, Bitcoin gave us the signal. We pointed out the signal in the Alpha report this morning, and we went line to line today. Now, the question is, will it last? Well, whether or not it lasts has to do with, first of all, we got our short covering. Great. That's great. That could be out of the system now because we were oversold there for a while. But whether or not this lasts all comes down to the capacity for this chart to keep going. Debt, boys and girls. And there's a second issue too, and it has to do with jobs. We'll talk about that in just a moment. But bond issuance, look, we're at the phase where as long as debt issuance continues, AI growth can continue. That's my opinion. As long as we keep getting debt issuance, the AI bubble can keep going. Now, if labor stalls and debt issuance slows, private credit, liquidity crisis, whatever, we are gloriously and royally effed. Now, I want to be clear. We do not want a recession. Recessions are very painful. Many people lose their jobs. They are hell. But things would get cheaper. Stocks would get cheaper. Houses, maybe. It depends on where as to whether or not they would get cheaper. Mostly because houses in many parts of the country, not a foregone conclusion that they're going to get cheaper because we have so vastly underbuilt. The New York Times actually had a piece on this morning that we are so underbuilding compared to historical pre-2008 averages. We are still underbuilding today. You know, our poor guy Graham, he made this like podcast here where he laments how horrible it is to build homes in LA. And I watched that and I go, I know. And that is why I love buying real estate in some of these blue states, because they're so retarded with their building policies that all they do is drive housing prices up. So if you want to hedge your investments and diversify into real estate by hedging whatever other investments you make, one of the best investments is literally investing in the stupidity of politicians. What is one of the best ways to invest in the stupidity of super left Democratic real estate policies? Buying in real estate markets that are exposed to those sort of political thinkings. So the more liberal the policies, the more you want to buy real estate there, because they're so incapable of building, they just drive housing prices up, which sucks for people who want to get in, But if you know the game, you just go, whatever. It's crazy. I'm not saying any of that is good. I'm just making an observation. I'm here to make observations about the market. That's my job. Okay. And again, I don't want, so that's why I say, like, yeah, in a recession, things get cheaper, but not necessarily because housing has been underbuilt and loans are pretty good relative to what you see in 2000, what you saw in 2006 and 7. That's pretty bad, 6 and 7. You know, loans are pretty stable. You know, there's some areas of the market, you know, FHA on the fringes and some of the overbuilt markets that are going to have problems. We know that. But, you know, generally you don't want a recession because you're going to lose your job. And so even if things get cheaper, you're just not going to have the ability to finance new real estate or stocks, which sucks, right? So therefore, the sudden concentration of debt, right? This is pretty sudden. This is a sudden concentration of debt, makes me a little bit nervous. And it either means we have to spend more to keep the Ponzi going, so to speak, which is, you know, to stay ahead of China or whatever, or worse, which, you know, for a World of Warcraft reference is out of mana, and for us means out of money. If companies are out of money, this is a really bad sign. And it doesn't mean the market's going to tank tomorrow, but it means we're like possibly on the last innings, which isn't great. Now, T.S. Lombard had a little piece on the supply session regarding labor, and we're going to touch on this briefly. But something that I do want to touch on briefly as well is this, like, one of the things that I like about artificial intelligence and artificial intelligence companies is I want to look for companies that have low exposure to these crazy debts. That's why I like what Meta's doing. That's why I've hated Oracle. We went back and looked at our analysis on Oracle, and we saw that the analysis that we did on this channel on Oracle, where I said way too much debt, stay away from Oracle, was on September 10th, my dad's birthday. Do you know what else September 10th was? Can you look at this chart and guess what September 10th was? September 10th, right here, folks, the top of that green line. I analyze Oracle. I go, guys, danger, danger, danger. Watch out. This is a bad fundamental play. You know, because you can analyze stocks in a few different ways. Fundamentals, momentum, right? And then you have to have a strategy associated with that. A good fundamental buy, you could hold for 10 years. A momentum play, you can't hold for 10 years. You swing in and out of that, right? But fundamentally, this was a bad sign, so you just want to stay away from it. Now, 200 divided by 345 means this puppy right here is down 42% since we did an analysis on this channel.
With AI,
you can create any character you want in seconds.
This used to require huge Hollywood budgets, complex software, and tons of time.
But right now, all you need is a laptop
and knowledge of the best AI tools.
It'll cost you practically nothing, and it doesn't require a subscription.
In just 2 days, all show.
Makes sense. Why? Because of debt. And this is why I say stay away from debt. Now, one of the things that we're doing, because we're going to release our AI app this week. It'll be coming soon for December, but we're going to .co. Vision is that we're going to sell the and we'll keep adding updates up, which will be a build the beta out for maybe it reinvest into the artificial intelligence without debt. So it's win-win. People who join get rewarded with the foundation. It's so much more expensive right now. I'm not trying to pitch it. The reason I'm saying this is because I am putting my money and my company's money where our mouth is. We don't want to finance our AI with debt. So we want to sell a really good service and give people lifetime access and then use that capital to keep growing the product, which is already, I think, very good. Like day one, I think it's already gonna be like, oh, this is kind of cool. You're like literally countrywide throughout the entire United States able to tell us if a deal is, you know, likely to be a deal in the eyes of Kevin or not, nationwide. This is really cool. Now, point of that is staying away from debt because that debt bubble rolls over when jobs roll over. Okay, so we're going to talk about jobs. Let me just quickly disclaim this just so I don't get in trouble with the SEC. If you want to invest in HouseHack or reinvest.co, it's the same company. Yeah, you still get a 5% yield, but make sure you read the offering circular by going to househack.com or reinvest.co. This video is not a solicitation. I'm using this as an example. Oh, great. Michael Burry just tweeted. NVIDIA emailed a memo to Wall Street sell-side analysts to push back on my arguments. I stand by my analysis. Obviously, the full analysis does not fit in a tweet. I will release my timeline, the first post, The Heretic's Guide to AI is up now. It's a very light read. Basically, all right, he's going to double down on the depreciation play. Look, we have already addressed this with Michael Burry. Remember, I said this last week. I said Michael Burry is not right yet. Then the market sold off and people were like, Kevin, it sounds like Michael Burry's right. No. Michael Burry has a depreciation play. That will take a while to play out. What you need for the Michael Burry depreciation play to play out is either the labor market to roll over, the debt cycle to stop, or both. Then the depreciation play will play out. Okay, so Michael Burry is like a future problem. It's not a today problem, it's a future problem. So what else is part of this today problem? Well, the supply session and the Fed. So what do we have over here? Ordinarily, the Fed would be chomping at the bit to cut rates because of the Phillips curve. Right, because our payrolls are trending near zero. The problem is, right now, we're not at zero. In fact, if you look at where we sit right now on payrolls growth, I made this little chart right here. Our 3-month average on Bureau of Labor Statistics provided payrolls is 62,000. Our 6-month average is 59,000, and our year-to-date average is 76,000. So we're not near zero. Once you hit like zero, 6 months later, it tends to get even worse. So once you go to zero for 6 months, it's bad. You're probably going into a recession. But we're not at zero yet. And so I kind of disputed a little bit about this article where they're like, oh no, this is bad. We're trending towards zero. We're not there yet. Now, of course, there are arguments that the stock market will fall, the stock market falling could cause participation to rise as early retirees come back. We already know that, old news. There's also this idea that, because the foreign-born labor supply is declining, native-born is going up. But this is apparently misleading because of the way they collect the data. Like, they collect survey responses, and if they're just getting fewer from one, they assume the other side is higher. It's, like, totally skewed. Just ignore it. It's a bunch of crap. Doesn't matter. So the point of bringing this up is that right now, it's unlikely we're going to see inflation like we saw in the 1967 no landing. Because back then, we had this massive worker shortage. Okay, so let's phrase this clearly to simplify this. What's bad for inflation is what happened in 1967 and 2021, which is having 2 openings per every 1 worker, okay? Right now, we're the opposite. We have less than 1 opening per every 1 worker. So this means we're not likely to see an inflation problem. They don't mention that in this article, so I'm sort of like leaning on this article to say, look at this chart, here's why it's wrong. We don't have an inflation problem right now. Yes, prices have gone up a lot, but we don't actually have an inflation problem. We have a bigger risk that the Fed is going to make a policy mistake by not cutting rates. That's, I think, why markets are also enthusiastic, because Waller said, hey, we're going to go for the cut. Mary Daly today is like, hey, we're going to go for the cut. So where does that leave us now? We have a lot of information here. We know what's going on with the AI debt bubble, the recession, stock performance and movements. We know to stay away from the debt plays, talked a little bit about real estate, talked a little bit about labor. How do we put all of this puzzle together? Here's how.
Methylene blue. I brought this up on a previous
We've all tried it, yeah.
We've all tried it. We finally found a partner that provides it.
First, we need to hold 605 on the Qs, okay? That's pretty important. Then, no more private credit pain. Also very important. Any kind of shock here, shock would be very bad right now, okay? So hold 605 in the Qs, no more credit pain, great. After that, we really want strong retail sales, we'll likely get because people don't stop spending until they lose their jobs. And then we go into the DEES 10 Fed meeting with a 98% chance of a Fed cut. So far, we're climbing over 76% because Mary Daly and Waller are pushing for that rate cut, which is great. This is U-turned the odds of a Fed rate hold, which on Friday morning, if you watch my video Friday morning, I'm like, this is actually good. Like, Waller's coming out trying to talk this up. Remember what we said last week? You need the Fed to talk up the chance of a rate cut. They have until this Friday to do that. So between now and Friday, talk up the rate cut, Get us to 98%. That's bullish. Strong retail sales we'll likely get. That'll be bullish. No more private credit pain. That'll be good. Then, if we can get through the next 2 months with few layoff announcements on top of what we've had, we might be able to get back to employment growth, and we stick a soft landing with major bull catalysts. Like, think about the bull catalysts that we have. Deregulation, that's huge. Then we have the tax incentives from the big, beautiful bill. That's huge. Then on top of that, we're expecting fiscal stimulus and rate cuts, right? Potentially stimulus checks, more rate cuts. This is all good. We're hoping inflation stays tame so we can keep getting rate cuts. We could stick this. So that's why I think there are opportunities to spend some money on those 10-year stocks to buy. And that's why I'm kind of in the middle right now. I'm like, I know we're shock prone. I'm selling where I don't like my exposure, and I'm buying things I'm willing to hold even through a recession for the next 10 years. And I'm trying to stay away from debt-heavy plays, because debt is what's going to take this economy down. As soon as that debt bubble in AI stops, I start getting nervous. And that debt chart, this right here, this should make you nervous too. Anyway,
all right. That is an interesting number to look at, though. Let me just go back a little bit on this video. So 2020, 2025. So we did do debt. So it looks like what, 20 billion in billions. So it looks like an average around this, like $10 billion average. And then and then recently, I mean, let me see if I can find it. There we go. Recently, we're seeing that the debt numbers just like skyrocket and not really slow down at all. $39.83 billion. Last update was 88 billion. So we are at the phase where, as long as debt issues continues, AI growth can continue. But if one company goes belly up, I mean, that's going to be the end of the market, I think, because everybody else is going to try to sell off any bonds, any debt that they have, and move on to try to preserve their money. GBT moment, almost no debt, and then OpenAI and all the other companies started doing debt here. And this, like, if we compare this level of debt, you know, going back to 2016, it's almost double of what the average is. Let's say if the average was 15, we're sitting at 88. And then look how quickly this debt numbers are growing. So if labor stalls and debt issuance slows, private credit, liquidity, so on, we're glorious. We do not want recession. It's very painful, but things will get cheaper. But then you might not have any money. That's the problem. To be able to buy some of this pain in the market. So this is cool to see. It's interesting. And then look at let's see what they're talking about here with the tech rally. Rebound, because the market did rebound insane today. I think we looked at it. Let's just pull it up while we kind of cover this. S&P. By the way, crypto is dumpy right now. Bitcoin is almost at 87,953. Yeah, I mean, we rallied today. I mean, here we are, the 24th, up 1.5%. Let's look at the 5-day. Yeah, I mean, Friday we were sitting at 65. Now we're at 67 for the S&P. And the problem is nobody trusts this market. Like, nobody trusts this market to buy into it and then keep it as a conviction, just because nobody really knows. The last couple times that the market really faked everybody out, like it went up, you think it's going to continue up, at 10:30, 11 o'clock it dumps, and at close it continues to it continues to dump. So it is scary for investors to have conviction if the market is a buy or not. So yes, we had a rally today, which is great, but is it going to is it going to keep it up? I mean, past a month it is really beat up down about 1.58, and that's not a lot. That is not a lot at all. Year to date, we're up quite a bit here. If we look at the S&P performance for the last few years, how has S&P and 500 done in the last 5 years? Show table. You're gonna see that the S&P actually has done really good for the past couple of years. We've consistently, it's just been green, 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 except 2022 wasn't that good. So 2020, 18%, 2021, 28%, 2022 obviously wasn't that good of a year, but going into 23, 26%, 2024, 25%. This is almost like, I mean, except here, everything else has been, up over 20% every single year on the S&P. And so maybe we do need some kind of like some kind of cool down here, because this is significantly crazy, because normally the S&P, people saying 8 to 13%, but this is if we close at 13% this year, it might be good. But we're seeing, the past couple of years has just been amazing for the market, in the exception of 2022. This is also should scare you. Are we gonna have a 2022 again this year? Are we gonna continue to go down? Yeah, Bitcoin is still dumping. Here's a chart of the S&P 500 total return. It is overall, the S&P has does an amazing job in giving you a good return year over year. But look at this. The last time we had this significant crash was what, negative 37%? That was 2008. But since then, it's just been nothing but really strong positive return every single year. This is 2018, didn't do too well, and then 2022 didn't do too well. But overall, it's just been really good returns. I mean, we're seeing this kind of there's a trend, it seems like, going lower and lower and lower here, starting in 2019. The only reason we had a good year in 2019 was because we were in the middle of COVID, and the government decided to dump a whole bunch of money into the market, and that was a 31% return in the middle of a world where everything was shut down. So kind of crazy. So it's like there's something just doesn't really add up. Like, how is the market still returning, really good numbers with all this money in the market? People can still afford a lot of the stuff since 2019, and even 2019, it was kind of scary that everybody was waiting for some crazy market move to the downside, and actually ended up being COVID that caused it. So yeah, I feel like we're going into something right now. The debt is really scary, and the market is just very, very, very frothy. Here's the 2000s. That wasn't that good of a year. 2001, 2000, 2002. Just terrible years. I mean, we could get this again, where every single year we just get beat up. Look at what happened in at least these years. 2024, 10, 15, 5%. 2008 obviously just dumped. But here you got 1990s where the S&P was, over 20% every single year. 5%. But then if you average this out, like we've been having pretty good years and nothing too significantly crazy here. 2022 was around elections and all that. Let's find out what made the market dump in 2018, because that is a big loss there in 2018. The hawkish Federal Reserve and the escalation U.S.-China tensions and the rising fear of global slowdown, all hitting at once. The Federal Reserve raised rates 4 times in 2018 and signaled more hikes ahead. The U.S.-China trade was escalating with tariffs and steel, aluminum. Widening list of goods created uncertainty. Data started to show that slowing in China and Europe economic growth, feeding worries, synchronized global expansion was rolling over and the U.S. growth would follow. Markets like FANG had become heavily index weighted, so their correction on regulatory growth and growth concerns dragged the broader indices. Yeah, and right now, if you look at what percent of the market do the FANG stocks make up, and you're gonna see this is a significant amount, especially right now because of AI and everything else. I mean, you have companies in the $5 trillion and $4 trillion. So, as of late, the FANG group, Facebook, Meta, Apple, Amazon, Netflix, and Google, I mean, this is not including NVIDIA, make up roughly about 20% of the S&P. How much do the top 7 companies by market cap, publicly traded, make up? So this is top 7. Now it's going to include NVIDIA and all that. So globally, the top 7 publicly traded companies by market cap currently add up around 20 to 25% of the total world equity market value, depending on the exact date and so on and so forth. Within the US, those same 7 names typically represent roughly 30 to 35% of the S&P. So you got NVIDIA, Microsoft, Apple, Amazon, Google, Meta, and Saudi Aramco, Tesla, Broadcom, and so on and so forth. So you have some of these companies just really making up a significant part of the market. If we have a downturn, all these companies are going to drag the entire market down. If we have a bad market, they will drag everybody down with them. And this is the fear, is when you have concentration up top, everything else is going to get destroyed. So let's watch this video. Let's see what they think of this rally that we had today, just 6 hours ago, and then we'll go from there.
We are sharply higher. It is the NASDAQ that is a ripper today, up 2 1/3%. We're good for 500 points. Coming off the worst week, as we said, for that group since April. Bitcoin had a rough week. Risk came out of the market, as you know. I think the big question we all want to know, where does this leave us now? Thanksgiving approaches. Not that much time left to go in the year. I go back to what Tony Pasquarello of Goldman Sachs said last Friday pre-open. He surveyed the landscape. He looked at the volatility and said it had some elements of capitulation, but he hasn't changed his overall bullish view. Quote, it's a bull market and the primary trend remains intact, the primary uptrend. Quote, I'm a believer that liquidity is set to improve. The economy should accelerate. The story may not be as pristine as it was, but that interplay is still pretty favorable. Does that match with how you think, Josh, about where we are?
I think it's a good take. I think the number one thing that you had to get right this year was that you could have rotation within the Mag 7 and that would be enough from an index level to continue to propel us higher. And then the number two thing that you had to get right was that momentum would remain the most powerful of all the factors. And just look year to date, momentum statistically is number one, up 21% on the year. Growth is up 17, quality up 9.6, value up 9.5, shareholder yield up 9.5. If you had an overweight toward multiple of those factors or any one in particular, you've had a great year. Hasn't been necessarily in a straight line, but overall, that's what kept you on the right side of the market. Low vol is the worst performer of that group. Shareholder yield is the worst performer of that group. So, like, you do have a lot of dispersion. And I think within that Mag 7 rotation, the most interesting thing to say is it's been very difficult to not be in that trade, even if at any given time, one or two of those names have been giving you trouble. There was a moment this year, Judge, where Tesla was just like a complete disaster. Apple had a moment where everyone was giving up on it. Amazon has had some really bad post-earnings reactions. Obviously, the saga with Alphabet has just been incredible, which I know we'll get to in a second. But giving up on any one of those names and then utilizing it as a reason to get out of the Mag 7 has been disastrous for people, because that rotation from one to the next, it's been really powerful, and it's kept this market moving up.
Weiss, we shook some things out undeniably last week, okay?
Yeah.
But back to what Pasquarello's saying. Do you agree? Are we still, A, intact? And even though we're not as pristine as we once were, that I'm using words that he used in his note, we're still pretty favorable. And if you look at the overall backdrop, you've got obviously the CapEx spend, you have a pretty good economy, which is going to, you know, many think accelerate into next year, and you got the Fed, which is going to be more engaged, obviously, on the cutting cycle. What do you think?
Yeah, no, I think are intact. I can't tell what the market's going to do depending upon what the Fed does. That's a short-term consideration. Overall, we do see the economy strengthening in some parts. Let's keep in mind we still can see the consumer weakening.
Yeah.
So it's a two-part economy. Now, you've got the largest spending that continues to be intact and driving the economy. So I think we're good, and I also think, and this is a term I really dislike, I think it's healthy to shake out the latecomers to the AI trade, to the tech trade, and so you can move up in a more reasonable fashion. We did get overvalued, unquestionably, but we're in good shape now. So I can keep going, with the with the mid-cap tech. I think the AI trade is far from dead, but there's still some massive overvaluations. Most are in the private market, by the way, not in the public market.
Well, Joe, so speaking of tech, I mean, Alphabet has been the best story of the last, few months in terms of this trade. Mm-hmm. It's defied a lot of expectations. It hits another record high today. It's up 11% alone since Gemini 3 launched last week. It was the only Mag 7 name positive last week. It's had a larger market cap than Microsoft for the first time in 7 years. That tells a lot. And if you need more, co-founder Larry Page, he's now the world's second richest person, passing Larry Ellison. So that's been a pretty good story, and that's one of the stocks that you own.
So I think what's happening is that we're looking at the AI trade, and we're trying to understand who is going to deliver the quickest on the ROI. And I think in the case of Alphabet, they're giving you the evidence that they might just be that stock that does it for you. Gemini 3 seems to be something that's certainly changing the story dramatically. I think in addition to that, it's the TPU chips that are obviously being utilized in the AI infrastructure. So it's the confluence of the TPU chips, Gemini 3, Google Cloud, and then you go beyond that, and you look at Android, you look at Waymo, and you look at YouTube, and you see this very diversified conglomerate that came into the year with significant questions surrounding an antitrust ruling and the fact that ChatGPT was going to cannibalize search. Now you've seen a reversal in that sentiment, a rebuilding of position. And to your point, when you look at the Mag 7, it really is only NVIDIA and Alphabet that's outperforming the S&P so far year to date. So we're seeing kind of this narrowness in the Mag 7 and the opportunities.
Becoming more, as Citi says, idiosyncratic, right?
Yep.
Which they think continues into the new year, in that what was a lump everybody together trade, it moved as this monolith, is not doing that anymore. Because as you look at all these companies, yes, they have the circular deals, they're reliant on one another in some respects, but they're competing against each other too.
Yeah, so I think if I could finish my thought, two things are important as you move forward. What the ROI is going to be on the AI trade, and then I also think what we've learned over the last 3 weeks is that valuations in tech do matter. And I think the market is going to be a little more judicious, saying, okay, we don't want the extreme valuation companies where somewhere down the line the dream is that they'll grow into the multiple. We want the companies here and now that have more reasonable valuations.
Lock in growth without locking up your money. A Marcus no penalty CD offers both the locked-in competitive APY and the ability to withdraw your full balance with, you guessed it, no penalty.
You gotta be flipping my flapjacks. This stock market's flipping flapjacks all over the place. Holy smokers, folks. This ain't no dang joke. Look at the public count here today, up $92,000. But you know what? It feels a little bit like receiving a participation trophy after the downfall the public count has seen over the last month. I mean, a month ago, this public count was over 4 million. So to be at 3.5 and have a great day like today, it kind of feels like, you know, a participation trophy. It's not the real deal Holyfield, right? Now, I was looking at the public count here today, and I'm like, man, some of these stocks are moving huge. And it's a lot of stocks that have been just hammered lately. Like, look at Amazon, about a 3% move. Meta, 3.5%. Honest, 3.5%. Estee Lauder, almost 4%. AMD, almost a 6% move. Google, McDougal, a 6% move. Palantir's, 6% plus move. SoFi, almost an 8% move. But you look at that, and you got to say to yourself, is this real, or is this just a dead cat bounce, right? You got to look at it from kind of that perspective. I posted this on X this weekend. Man, if you told me 10 years ago, 800,000 plus people would care about I ordered a Tesla, I would have been like, you got to be kidding me, man. That's crazy. But I ordered a new Tesla, right? And this is very, very intriguing because I ordered that Tesla, and my Tesla hedge gets destroyed today on the back of my one order I placed for my new Model X. Look at that, down $7,300 on my Tesla hedge here today. Now I'm only at a 25. First one is, where's the Tesla hedge, right? Third, if I sold that Tesla hedge today, what stocks would I buy with the money right now? We'll speak about that in this video here today. One thing all I need from you guys, and it's as the sign in my garage says, all I need you to do is just smash that like button. I appreciate everybody that's already done that. You didn't even need me to say it. And if you haven't already, please join the Smash Gang. That's all I ask in this video here today, okay? Additionally, if you want to be subscribed here, you can certainly subscribe. Very exciting times, ladies and gentlemen. We are 3 days away from the big 1000X sale for Black Friday, 3 days away, folks. So pinned comment down there if you want to receive that sale. Keep in mind, I will not be recording a video Thanksgiving. I'll speak to you. Click the pin comment. I will know for 1000X stocks. Where, if you look at crypto first off, okay, crypto has stabilized over the weekend, right? Bitcoin trading 88, 89,000. That was, you know, at the lows, it was down to like 80,000. Ethereum has stabilized now. If we went back just a few days ago, it was 2,700, now just under 3K. So this is a step in the right direction. The fact that crypto stabilized over the weekend. But let me push back against this for just a moment. In order to see real stabilization in any asset class, I don't care if it's a stock, the market indexes like the NASDAQ, the S&P 500, I don't care if it's Bitcoin, I don't care if it's Ethereum, you really need to see stabilization over at least several weeks, if not a month-long plus stabilization period. For an asset to stabilize for a few days, it's a little positive, but it's not like you can't just say, oh, we made it out. We're out to the other side. It's stabilized for 3 days. Like that, we won. Like it's over. It's all up from here. Doesn't work like that. I can show you every crash period we've gone through. Assets would stabilize for a few days. Remember, many of the biggest up days in stock market history were during the great financial crisis when the market was still crashing. So you would have big bounce back days, right? Where assets would stabilize, things would be like, okay, it's okay. And then they just go lower. 2022 is another good example. Like the market would stabilize for a little short-term period of time. And at the end of the day, where it just keep going, it just kept going lower, right? Additionally, if you look at the Bitcoin cycle, which we'll see if this ends up being correct or not, but as of right now, we're supposed to technically be bouncing when it comes to Bitcoin just a tad bit here for like basically now and maybe the next couple days here. But basically, Bitcoin is supposedly supposed to go through massive downside Thanksgiving to Christmas. Okay, Thanksgiving to Christmas, Bitcoin is supposed to go through major downside. And basically, you know, we can talk about just after Christmas, Bitcoin should supposedly be trading at 60-something thousand. We'll see if this whole Bitcoin cycle thing ends up being accurate or not. But if it is accurate, just understand there's going to be a lot more downside for Bitcoin, which will obviously bleed into the stock market as well, because that's how these financial markets move nowadays, right? After New Year's, essentially, then Bitcoin's supposed to go through a big up cycle until it peaks, you know, we can call it 80,000 plus. And then it's supposed to go through another massive down cycle, bottoming in basically Q4 of next year around 30,000. We'll see. Don't, you know, bank on this happening or not happening. Just keep in mind, if this Bitcoin cycle whole dealio plays out, like this is the way it's supposed to play out. So, you know, don't get too excited, don't get too down, those sorts of things. No, when I look at the market in general, I want to look to the generals. I want to look to the big dogs. I want to look to our fearless leaders. How are the fearless leaders of the stock market doing? That's going to give me some intel on, are we actually getting a real bottom in the market and we're starting to head up from here? Is this just a dead cat bounce? So I'm going to look at NVIDIA. Now, there's something I noticed with NVIDIA stock that's very interesting today. I was looking in, you know, the NASDAQ, the Qs are up like 2.5%, 2.7% today. And yet NVIDIA couldn't even match that. Like I'm watching it throughout the trading day and it's only up 1%. It looked incredibly weak on Friday. And you have to ask yourself, if the stock market's ready to bounce, right? If we reach the lows already and we're going to bounce from here, you have to ask yourself, why is NVIDIA not bouncing? Why was NVIDIA not up 5, 6, 7% like some of these other stocks today? That's our fearless leader. That's been clearly the stock that has led us out of the lows of 2022, that peak, that bottom in 2022. The stock that led us out is NVIDIA. It's the big dog of big dogs. So you'd have to think, if there was actually real confidence, we have bottomed out the stock market, all the damage is done, and it's up from here, you would have to assume NVIDIA would lead us out, right? And the fact that that stock is so incredibly weak makes me question things, right? Because on Friday, remember I was on X posting on Friday, I said, you know, NVIDIA had been basically green that entire trading day. And I said, this stock looks like it wants to go red. Keep an eye on it in the last hour. And sure enough, it ended up finishing red, ended up going down like almost 1%. And that was after almost the entire day it was green, nicely green at that, and it gave up all those gains. And to see it underperform the NASDAQ so severely today, it makes you say, why? Like, well, why is that stock so weak? We know the numbers are great. We know the guidance is great. We know 2026 is going to be great for their numbers, but yet nothing for the stock? Smells a little fishy, does it not? Oracle, look at Oracle stock. This adds to the sketchiness. This stock cannot bounce at all. Like, this one just keeps going. Like it's up 0.29% today. Put me to sleep. Like, basically, the NASDAQ's up like 10x more than that. So the fact that Oracle is so weak adds to sketchiness and makes you say, like, is this really a real bottom today, or is this just kind of a little bit of a dead cat bounce situation in regards to the market? Now, one stock I can tell you that is not dead cat bouncing, it's Google McDougal. This stock is one of the strongest stocks in the entire stock market right now, if not the strongest stock in the entire stock market right now. It is incredible. Stock hitting $319 here today, up another 6.5% in the last 6 months. This stock, and this is a mega cap, so it's shocking it's made this big of a move the past 6 months. It's up 86%, okay? I've got great news for Google McDougal shareholders. If you're a Google shareholder, I've got great news for you, okay? Google stock climbs after this analyst says Google will emerge as a major winner in artificial intelligence and cloud computing. Analyst Nick Jones, who initiated coverage with an outperform rating and a $355 price target, said Google's mix of search dominance, YouTube's ad scale, and steadily expanding Google Cloud business positions it well for the next phase of AI adoption. The analyst said Google's recovery has accelerated in recent quarters as regulatory pressure eased and investor confidence improved around its long-term AI roadmap. He added that the company's ability to show visible AI progress across search, ads, and enterprise workloads could support further multiple expansion. We see Google as an AI and cloud winner, says the analyst, adding that YouTube remains one of the strongest global video ad platforms at a time where marketers are shifting budgets toward measurable formats. Okay, here's the deal. Here's why this matters so significantly, okay, in regards to an analyst like that. Listen.
It turns out that there are two fundamental ways of looking at the world, and I think we picked the wrong one. If the risk of life is death and evil, then you need a map that shows you the way that justifies that risk. How do you pay attention to what you don't understand? That's a complicated problem. But if the world is made out of order and chaos, they need to be able to maneuver in both. It's an investigation into the structure of perception itself. I've seen what it's done to thousands of students. When someone is first about to embark on a minor task, but that minor task...
If we went back 6 months ago, 9 months ago, 12 months ago, the analyst community was insanely bearish on Google. Like, they just didn't have a lot of positive things to say for the most part. All the Wall Streeters were doubting Google search and disruption and all these sorts of things. Okay, listen, at this point in time, that is a thing of the past. That is a thing of the past now at this point in time. Absolutely no one is doubting Google anymore, which means the stock can continue to see momentum because people are going to look at the stock and they're going to look at it from a risk-reward standpoint of like, this is a moneymaker. It's a stock with insane momentum in a market that is shaky right now, right? And additionally, people are looking at it as not that risky because you took the risk off the plate now. The risk was, they're going to be disrupted by ChatGPT and blah, 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 right? And they're not going to be successful in AI. Now people are like, they're looking pretty darn successful. And I don't know if you guys got to see this news. This was pretty huge. Google Gemini 3 crushes benchmarks and outperforms ChatGPT. Google just delivered something remarkable with Gemini 3 and the launch of Gemini Agent.
The problem, I love this for Google, but this is such a big problem for Google. Because whenever they come out with some amazing product, they're going to be in Congress debating over monopoly. So Google doesn't benefit from trying to show their strength. They need to continue to show weakness and letting some of these companies take foothold of the market so we can continue to innovate and come up with new products and let the smaller players in the market actually take some market. So Google doesn't get stuck in Congress talking about why they are a monopoly, blah, 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 this, blah, 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 that. So Google's biggest weakness is their strength. So as much as I like this, I think this is also a problem for them. I think so. They can't win in everything. It's going to become a monopoly. It's going to become a problem.
Darn successful and get more successful, and that comes as no surprise. Like, we know Google's been way out in front of this, working on this for decades when it comes to this technology, right? Now, that leads me to Salesforce stock, because if you look and you kind of read through this commentary here, right, talking about enterprise tools, talking about how enterprises are going to work in the future and whatnot, right? This is more proof, in my opinion, that Salesforce is pushing in the right direction with their agent force and everything they're up to there, okay? Google will lose to Salesforce long term when it comes to enterprise tools. When it comes to enterprise cloud, obviously Google's a huge winner there. But when it comes to a lot of these enterprise tools, Salesforce is always going to be great there because they're always going to have tools that are good enough, right? And they have you in the ecosystem. The ecosystem is so important. It's the same reason why people can't leave the Apple ecosystem. Once you have somebody in the ecosystem, you can't, it doesn't matter what phone Samsung comes out with or Google comes out with, like they're not leaving to an Android device, right? And so the very similar phenomenon happens with Salesforce, where they get companies, businesses, enterprises into that Salesforce ecosystem. And once you're in that Salesforce ecosystem, like you're just sold the next product, and you just can't get out. And so Salesforce, like, this is just more proof that they are in the right direction, because the fact that Google wants to push harder means that this is a big opportunity here. And so Salesforce is at the forefront of a next big kind of, in my opinion, positive inflection for their business model over the next several years. And you'll see that really come through with Agentforce and their other products they'll be launching here, okay? Now, Google McDougal just became my 6th stock in the public count out of my current positions to hit a triple-digit gainer with a 102% gain. That only trails Revolve at 106% gain. SoFi at a 229% gain. Meta at a 432% gain. Elf at an 878% gain. And Palantir at a 2,111% gain. AMD, it was at a triple-digit gainer, but it dropped off. So AMD, next time it bounces a little bit here, we'll be back into the triple digits, and we'll have 7 current positions in the public count with triple-digit gains. And keep in mind, it would be 8 if it wasn't for the fact that I sold Tesla, because Tesla, I put $13,000 into that and made $279,000 out of that. So that was like, we can call that like a 2,000% gain or something insane, right? Now, if you want to know the next Google stock, the next one, in my opinion, that's going to make a big run, it's going to be Adobe, in my personal opinion. I think that's the next Google stock type situation here. I think Adobe sets up like Google did last year, where people are doubting it. There's so much negativity around the stock. The stock's down 38%. No one's, looking at them seriously and whatnot, right? And I think Adobe sets up so well. Looking at a stock here that has a forward P of 17, earnings per share growth of very strong double digits expected next year, revenue growth of, double digits. And I think they're going to be doing double digit earnings per share growth for years and years and years to go into the future, right? Their products are very sticky company, right? We're looking at 1000xstocks.com right now, right? Look at the charts feature of Adobe. Does that not look like a perfect stock? Like, it doesn't get more perfect than that. This is where Adobe's at right now. This is where Adobe's been. This is where they're expected to go. That's a perfect stock. Adobe is literally perfection. Look at the margins here. Whenever you can have a company pushing gross margins near 90% and net margins around that 30% number, you're in a perfect stock. And Adobe is that company that pushes these gross margins to near 90% and net margins of 30%, right? It's incredible. Look at the trailing 12-month earnings per share growth of this company, right? It's clearly on the right trend, and look at what's expected to happen in their earnings per share growth over the next year or two. Unbelievable. Additionally, look at the operating cash flow trend. This is where we're at right now on a trailing 12-month basis. Look at the operating income. This is where we're at right now on a trailing 12-month basis. And look at the shares outstanding of Adobe. Down, down, down. So they continue to buy back shares, continue to take shares off the market while their profitability continues to increase. At the end of the day, eventually people will give up on the whole bear narrative around Adobe like they have now for Google, and then they'll start to take Adobe more serious. And so I think if we look out a year from now, I think we're going to have a very similar phenomenon that has transpired with Google in the past year. And people will give up on basically this bearish narrative and be like, okay, we just got to buy the stock. It's a money maker, man. These companies are some of the best business models in the world, right? Adobe's got one of the best business models in the world, bar none. They got a subscription business model that just keeps renewing and recurring and sticky. And it's like they sell more products and services to their customer base. It's incredible. So yeah, that's it. Now take it back to the market, right? My bottom line is I don't trust the market until January. In January, I can begin to trust the market again. But I just don't trust this market short term. I know the market's supposed to be amazing in November. The market's supposed to be amazing in December, right? I don't trust it right now, right? Now, does that mean I'm not going to buy? Heck no. I love to buy in a market that's not trusted. That's one of my favorite markets to buy in. And speaking about that, I just made a big announcement just last night inside the private stock group. I said, FYI, I just bumped the public account to $1,000 a week for buys from $500. I also just increased the amount I will be buying in all my private portfolios each Friday. This is set to run through December 2027. I'll be doing some pretty substantial buying weekly the next 24 months essentially, right? So I'm bumping because basically I have certain amounts of money that are going to go into all my portfolios, right? The Patreon portfolio is $250 a week. The public count was 500. I'm bumping that to 1,000, and then I have a certain amount that goes into several of my private portfolios as well. I bumped them all up. And so I'm ready to come in with big buys, which means I'm expecting kind of a shaky market here and there. And I see a lot of great deals out there right now. There's so many stocks I want to buy right now. So many that I'm like, I have to up my weekly buys. I have to do it, man. And so I'll be upping my weekly buys for the next 2 years, essentially, and it's going to be fun times, right? I also wanted to draw you guys' attention to this because this matters significantly with this whole market drama recently, right? How often does a stock market decline? 1% drop happens 50 to 60 times a year. A 3% drop in the market happens 7 to 8 times per year. 5% drop in the market happens 3 to 4 times a year. So that's what we had here recently, right? That happens 3 to 4 times a year. 10% drop happens just over every 1 year, so every 1.1 years. A 15% drop happens every 2 years. A 20% drop happens every 3.5 years, and a 25% drop happens every 5 to 7 years. And that's an S&P 500 average since 1928. So basically, looking back at the past 100 years roughly. The moral of this story is when we go through these 1 to 5% drops in the market, don't freak out. Like, that's just normal, man. You're going to have that happen several times per year. This is nothing, okay? 10% drop. Now we're talking. Now we can start coming in with some big buys, right? And keep in mind, if the market ever drops 20% plus, you're in a freak time and you better be buying with both hands. As much as you can possibly get your hands on, okay? Because those 20% drops very rarely happen. And it could be years and years before you see another 20% plus drop. So you better take advantage of that. Always remember that, ladies and gentlemen, okay? Alrighty, next up here, my Tesla hedge plan. Let's get into that, and then we'll talk about if I did sell my Tesla hedge, what stocks would I buy right now, literally today? What are the best opportunities I find in the stock market, okay? Listen, my plan with the Tesla hedge. My plan is to cash that hedge at some point in the first quarter of 2026. That is my plan as of right now. Now, a lot can happen between now and then. Let's say, hypothetically, this market can't be trusted, and let's say it goes down a bunch in December. Let's say we have a rough December. Let's say Santa Claus just gives us a big stock and a coal. You might see me cash that at the end of December or maybe even the beginning of January, right? Now, let's say market stays fine, maybe even starts to bounce back, maybe even hit all-time highs by the end of the year. Then I'll likely carry that through deep into the first quarter of the year, essentially. Okay, because remember, that's a hedge, so it's there for protection. It's like insurance on the portfolio is the way I would look at it. So it's there in case things go bad. If things go bad, I'll cash. I'll take my profit and I'll run. If things don't go bad, I'll keep it as insurance there, right? So that's kind of my perspective here, right? Now, the fact that that post got 871,000 views is crazy. Like, it's like the fact that I just posted like, oh, I bought a new car. Like, that's wild to me. Wild, right? No, I answered a very important question on X because somebody's like, $123,000 to spend on that? Why? What are you thinking, Jeremy? Like, just invest that money, right? And this was my response to that, right? Because it's fair, like $123,000, if I took that money, I'm buying this vehicle cash. If I took that money and you could run the numbers on it, I invested over the next 5, 10, 15, 20 years and got 10% return, 15% return, 20% return, whatever. It's a lot of money, right? And I said, people ask me, why not just invest $123,000? I said, I invest plenty. I'm a huge believer in spending money also and supporting jobs, people making a living. I don't just hoard money. I love to spend at local businesses, big businesses, and everything in between. I also love to give to charity. December is actually my big month. I give to a bunch of different charities out there. It's something I started many, many years ago, and I like to do that. I said, a lot of people support me, so I love to help support others, right? And by me buying that vehicle, factory workers can make money off that, and a bunch of companies can make money off that, and Tesla can make money off that, and right? And it's just like, what am I going to do? Hoard all the money? Went out to dinner last night at North Italia in Summerlin, and, $195, and the waitress gets a $40 tip, and some of that can go to the bus boys and all that stuff, and, the chefs make money off that, and it's great. Get to have a great time with the family. And, I could have just stayed in. We could have just ate ramen noodles last night, but I like to, support the economy. American Express can make money off that. Everybody makes money off that, right? Like, come on. Like, you know, or they wouldn't have made that money, and then, you know, the chefs in the back room wouldn't have had as many hours, and, you know, the waitress wouldn't have made as much money, and the busboys and all those sorts of things, right? And so when you climb the ranks of having money, you want to allocate that money in an intelligent way. You always want to basically be investing more than you're spending, right? That's very, very key. You got to always have more income than expenses. And so that's something I've done my entire life. But with that being said, I don't play this game cheap. I like to support people because I think about my childhood. And when I was born, right, my family was very poor. My dad was working at, you know, used car dealerships and all those sorts of things. You know, it was like, you know, a struggle, right? And trying in and out of jobs and working for people and just a struggle, right? And then he started his pool cleaning business around 1994, I believe, 1995, right? And, you know, through building that business over the time, and I would go to work with him all summer, every day, right? We'd go clean pools and do service on pools and whatnot, right? And clean fix motors and, like, you know, put in new filters and all this stuff. We were able to move out of that area into a nice middle class area or upper middle class area. And I was able to get around other people, and it was a type of school where, you know, everybody was going to go to university, and, you know, by having friends and, you know, girlfriend that were doing very well for themselves, it got me to really open my eyes to the world some more, right? And got me to see, like, oh, there's other possibilities out there. And through that, I ended up going to community college. And through community college, guess what? I ended up getting into accounting courses and took several accounting courses and got into business courses and marketing, and, like, realized, like, oh, I'm very, very passionate about business and all this sorts of stuff, right? But if it wasn't for all my dad's customers, you know, giving him a shot, right? And hiring him to clean their pools and fix their pools and all that stuff, right? Like, that would have never happened. And I probably would have been in poverty forever. And, like, you know, maybe I never would have went to college. Maybe I would have never got that spark, that idea of, like, you know, business and investing and all these sorts of things. So I think back to then and, like, how that changed my life. So I'm like, I like to pass it forward, right? Like pass it forward. Right now I'm building a house. It's going to be a $5 million house when it's all said and done. $5 million, right? I could have just hoarded that money. Just, you know, I'm not spending anything. You know, live in an apartment or whatever. Like, I could have done that, but that gives a lot of people job opportunities. Like, I go by that house sometimes and see the construction, like how many workers are working on that house is insane. And the amount of companies that will make money off that house being built and the amount of equipment, right? It's great. Like, it's great. Like, you know what I mean? Like, I got it. I can spend it and, you know, support other people. A lot of people support me. And so I never look at this game as just hoarding money. I look at, you got to build up the ranks, continue to build your wealth, but don't just hoard. Don't just look at it from the perspective of, like, basically like I would call it like scarcity mentality, because I think a lot of people in this world have scarcity mentality, and it's not a healthy thing to have. And I think especially when you're a business owner, when you're doing things out here in the world, when you're an investor, you want to have abundance mindset. You don't have abundance mindset like, ooh, it's going to be rough, right? Because we could all say we're not going to buy any new vehicles, we're not going to buy any new houses, we're not going to hire anybody to landscape our yard or do this or do that, right? And we're going to have ridiculous unemployment, and then no one makes money, and it's just ridiculous. Like, I believe in abundance mindset. I moved to that mindset many years ago, and it changed my life. I can tell you that. Being over here in this scarcity mentality, a zero-sum game, you know, oh, the world's so unfair. Oh, they have so much, I have so little. Like, it is so unhealthy, man. It's a brutal place to live. And when you're in that mindset, this world's no fun. I just tell you that, man. This world's no fun. Over here is a blast. When you think like things can get better in the future, when you think companies can grow, you can grow, you're going to grow your net worth, woo, it's a game changer for you. And you see that opportunity. You know, the fact that some guy has $1 billion means it changes nothing with my life. If somebody's watching this video right now and you just made $1 million in the stock market today, great for you. That means nothing to me. Like, that's phenomenal. I'm super happy for you. I'd much rather have you make $1 million today than lose $1 million, right? That's like, how the companies operate, all that. You got it. Let's say it's $50,000 or whatever. What stocks would I buy? Keep in mind, this is very difficult because there's so many stocks I want to buy. Like, I'm looking and I'm like, oh my gosh, there's so many stocks I want to buy right now. It's ridiculous. Okay. So if I had to do it, here's what I would do right now. I would put $10,000 in Adobe right now. Forward P is 17 on that stock, double-digit earnings per share growth, double-digit revenue growth, for them expected in future years. Like, I think Adobe is just a great buy. It's a hated stock. I see it as next Google in regards to a hated stock that will be loved a year from now. Okay. Salesforce, $10,000 I would put into Salesforce. They just got their acquisition done, their next big acquisition done very, very recently here. Analysts have them only growing revenue 8-9%. I think they're about to go double-digit revenue growth again because of the acquisition and what that's going to add on to the business's revenue. And then additionally, Agentforce is really going to start to show up as a big revenue driver, in my opinion, 26 and 27. So I think their revenue growth could actually start to accelerate back up to double digits again. And I think that's what a lot of analysts are missing in regards to Salesforce. Benioff, you don't bet against Benioff. You don't bet against Benioff. That dude is a business legend. Talk about not having scarcity mentality. That man definitely has no scarcity mentality. And, you know, Salesforce 27 forward P, you might say that's a little high. None of this company is going to grow earnings per share at an extremely strong double-digit clip and grow revenue at a double-digit clip. That's not strong. That's not high P at all. And keep in mind, a lot of their contracts, they lock in their customers for years. So, and their customers are like the best customers you could really want, like enterprises. Like, so Salesforce, I love that one. Big opportunity there. I'd put another $10,000 into Amazon, a stock that's very hated right now. Forward P of just over 30 on the stock's way too cheap. Keep in mind, Amazon should have double-digit earnings per share growth and revenue growth each year for years to go in the future. People are really like questioning the whole depreciation thing, which has been a fair subject, and I spoke about that on the channel a lot recently. But Amazon's always been asset heavy. I spoke about this several times over the last week or two. Amazon's always been asset heavy. Yeah, they're spending a lot. Yeah, they're going to have big depreciation. That's nothing new for Amazon. Amazon's always been a crap margin business. Like, you know, I should have pulled up Amazon's margins on 1000X as well to show you guys. Amazon's gross margins, net margins have always been crap. They're going to remain crap for years to go in the future, and that's fine. At the end of the day, Amazon's on the path to $1 trillion plus revenue company and being the first company in history to do $1 trillion plus of revenue per year. And they're going to likely hit that in the next 3 years, ladies and gentlemen. Like, that's incredible. Incredible. So that's where Amazon's headed. So yeah, Amazon, I love that as a buy right now. More stocks I'd buy. I'd put $10,000 into Cake. Cake, you know, 2-year forward P on this one, a 10 with, you know, this company has a, you know, 10-year plus track record of growth ahead of them. You know, like, there's such an opportunity for the North Italia expansion, the Flower Child expansion there. Like, I'm just baffled that it's trading at these sorts of PEs, but yeah, it doesn't really matter. The bottom line is I'm getting a great deal. I'll continue to acquire shares, right? Double-digit earnings per share growth likely on this stock over the future years. Celsius trades at a 23 2-year forward P right now, which is way too cheap for a company growing at these sorts of growth rates. Celsius is going to be growing at here. And then e.l.f. Beauty trading at a 2-year forward P of under 20 right now. With the sorts of growth rates e.l.f. is going to have over the next few years, that's trading way too cheap as well. You know, keep in mind, Celsius is on its way to becoming a drink giant. I always love to buy companies before they are a giant. I love to buy companies before they're the giant, but it's clear to me they're becoming a giant, right? So like SoFi is a good example. Like, I look at SoFi and I'm like, this is going to become a banking giant over time, right? I looked at Palantir years ago when I was buying shares of that stock like crazy, and I said Palantir is the next, you know, massive company likely, and we can put it the SaaS related space, right? And then I look at companies like Celsius, e.l.f. I'm like, this is all three of these stocks, like Cake's the next massive restaurant giant. Some might already consider it. I actually don't yet. I think they're on their way to becoming that, essentially. Celsius, I think that's going to become a brand name that everybody talks about in the stock market in the next 5-10 years. Celsius is on their way to becoming a drink giant. They're not that today, but they're clearly, in my opinion, on their way to becoming that. And then e.l.f. is on their way to becoming a cosmetics giant. They're not that today, but they're on their way to becoming a cosmetics and beauty giant. And so those are three companies that I'm just like, they're the future. Like, they are the future, but it's at a point in time where I think it's more obvious to be able to see it now, right? So, no, but there's a lot of other stocks. Like, there's so many stocks I want to buy. I don't know if you guys got to see this video on the reaction channel. It's called Jeremy Lefebvre Makes Money. I did a video on Friday called 14 stocks I just bought, and I went over all the stocks I bought last week, essentially, because there's a long list of them, man. There's so many deals in this market right now, which, once again, tells you why I'm upping my weekly buys, because, man, there's a lot of opportunities in this market. But the biggest opportunity out there is 3 days from now, ladies and gentlemen. The 1000X sale is coming. That's for the entire software suite, the education portal as well, which I need a lot of you guys need. So I don't care if you're a beginner investor, intermediate investor, or an advanced investor, 1000X is the product for you. We got investors that use 1000X that are literally just have their first like few $1,000s invested.
Welcome to the ARK Venture Fund.
To date, to get very good.
All right. So are you gonna buy more? Are you gonna start buying more stocks when we go into the next year? Looks like Jeremy's up in his buys. He's always been in the market for a long time, so he has pretty good wisdom. But I don't know. I think I'm still iffy about what's going on in the market. I really don't like how the U.S. is literally hanging on a very thin rope. Uh, the entire GDP is being held up by AI. If the AI sector falls apart, the whole US economy falls apart. And the AI industry is held up by debt. And so that's a big time no bueno. And so it's really scary to see that and really be very bullish on the economy right now. And it just feels like that the bounce that we had today wasn't due to anything too significant. Like nothing really changed. I think maybe we were just in an overbought situation, oversold situation, and the stock market is just adjusting for that. But let's see what Crossroad is talking about here. BMNR definitely jumped up today significantly. Let's look at BMNR. Did jump significantly today, but that's due to Ethereum bouncing a lot below the bottom. BMNR also issued dividends as well of about a penny. But this jump is mainly due to Ethereum and the market just being oversold. Had a really good run today. But let's look at this break. Let's see what Crossroad is talking about here, and then we'll go from there.
Just did a Bitmine update, but it is 20% today, and I figured another update would be prudent. We're going to go look at why it went up. We're going to look at it relative to its other peers. They hit a critical mark today. We'll look at that update as well as a near-term update that could change a lot of things for Ethereum and, of course, impact Bitmine as well. Let's take a look. So the first thing that we can see here, by the way, is that a lot of names are up. This is a very, very green market right now. And Bitmine is up, at least at the time of this recording, about 20% overall, falling a little bit after hours. Now, if you look at some of its major peers in the DAT strategy, you can see ETHZilla, SBET, and ETHM all up here as well. And yeah, they're not up. They're up a good bit, but they're not up nearly as much as BMNR. Now, why exactly is that? I think part of it too is maybe the short interest of BMNR and also the liquidity. If you look at, by the way, let's go back here. We can see this. Let's zoom out a little bit over the last 3 months. And there we go. So over the last 3 months, and then that's volume. We're going to change actually year to date and go to 1 day. You can see the volume here is impressive over the last 3 months. It's the highest it's been, and we'd actually have to go back into August to see a higher number. That's really, really good for a strategy like Bitmine. Also very excellent is that since they're up 20%, we talked about it in the previous video, that at the time of earnings, it implied that they were trading at a slight, and I mean like 1% premium over the actual net assets under value. What this meant is that they were in a kind of a challenging place, and a lot of people were wondering if this meant perhaps that Bitmine would stop buying nearly as much Ethereum. And the answer is no. We got an update here today that they reached 3.63 million tokens and total crypto and cash holdings of 11.2 billion. And this right here is that critical landmark. Now, their goal is the alchemy of 5%. You can see it right there. 3% is a good chunk of the Ethereum supply token that's out there, 2/3 of the way to their goal. Very impressive as well. And we can see, of course, they even have raised some cash too. So it's interesting. You know, it looks like that maybe before earnings that they took advantage of the remaining MNAV. But what this means basically is since Ethereum is up a lot less than 20% today, and BMNR is up 20%, their MNAV is actually trading at a higher premium. Now, if that continues to go up, that's a really good thing for Bitmine because, again, they will sell their stock, which is trading at a premium, buy undervalued Ethereum. And as long as Ethereum accumulates in price over time, doesn't happen every day or every month, then they're going to be sitting in a very nice spot. So I think that mostly explains why Bitmine perhaps went up so much more than its peers. Again, looking at that chart, none came even close to 20%. They didn't even break into double digits. That'll happen from time to time, but a big part of that is this is a very retail heavy story. We see massive amounts of volume, especially at the end of the day. People were very excited to be buying BMNR as well, or also selling. That's actually a red candle there. But nevertheless, great thing to have additional liquidity. It's something they put out every single week where they talk about their liquidity just because it's so valuable for their strategy. And they're in a really good spot as long as Ethereum has bottomed and continues to climb. Over those cycles and over that time, Bitmine will outperform Ethereum. And of course, if we go and when we rather go into crypto winter, it will underperform Ethereum as well, which is why I think it makes sense to add both. Now, why was the stock market so green? And of course, Bitmine benefited from it as well. And it's largely around this. This is rate cut probabilities towards just coming up for their Fed meeting, December 10th, last meeting of the year. And this has moved around a lot. It used to be that the consensus view was 91% a month ago that we'd have a rate cut, 3.6% that we would have no cuts. And there was actually even more saying that there would be 2 rate cuts than no rate cuts. A week ago, things shifted in a hurry. Now, a lot of this was that due to the shutdown, there wasn't credible data, and it sounded like the Fed might be reticent to actually cut again in December, waiting on more data. It's a stance that makes sense, but probably was a mistake. And instead, so we saw them go from a higher probability of not having a rate cut to today, 84.4% chance. Now, we're not going to go into the reason for that, but largely it's around Fed governor comments that indicate that they are very willing to cut rates as well. We'll have to see on December 10th. But in my mind, Powell does not like surprises. And as time gets a little bit closer, I think that he tends to say, hey, it sounds like that what we're going to do is this. So make sure that people understand that going in so there's no surprises, because that's honestly one of the worst things that the Fed can do. They had to do it in the past, but man, so very likely that we are going to see a rate cut. Now, why is that a good thing for Bitmine? You would think it doesn't make any sense, but that's one of those monetary policy things that usually equities do quite well, and also crypto in rate cutting cycle, as long as it provided that these are not emergency cuts and they're not cuts because everything is deteriorating so fast. Are there cracks in the economy and the lower end consumer? Absolutely, but that's not nearly enough. Now, the other reason why perhaps Ethereum began to revert is that liquidity event in October. It took a while to resolve, but I think that we might be towards the end of that. But there is a major upgrade that's coming out for Ethereum, and it's called the Fusaka upgrade. This is actually 2 upgrades, the Fula and Osaka. Now, I won't go too deep into the weeds as far as what this means for everybody, but overall in the chain, this is happening December 3rd, kind of later in the day. Well, it's UTC time, so I guess mid part of the day if you're in the United States. A lot of people, by the way, see it as deflationary. I am not so convinced. I think that it might actually be slightly less deflationary than where Ethereum is at. Of course, that can be adjusted in further forks and upgrades. But this does a couple of things. So one is a big part of this is efficiency and transaction speed. So used to be back in the day, the blobs, these chunks of data that are used by the Ethereum network would have to be checked by literally every validator, which meant that you slowed things down more than they needed to be. Now, instead, this is kind of so you can imagine this massive river, and people are like, hey, let's make sure that there's no pollution in here. So let's check literally every drop. Well, maybe that's not the best way of doing things. And so instead, they have changed and shifted a couple of things. So one is PeerDAS. And basically what this is it's called Peer Data Availability Sampling. So it's like taking that whole river and instead saying, we don't need to test every drop of water. Let's instead test enough to make sure that there's no errors, but that means testing select drops along the way, or in this case, basically a smaller sample of blobs. So that's what it is. That means that instead of clogging up the network by every validator validating every single bit of every transaction, this is still very stable, and I don't think they'll have any issues with this, and yet there is a lot less volume as a result. Now, they're increasing gas fees, the maximum gas fees per block size. What this means is that you can actually have larger and more complicated transactions. That's a great thing, is a network is utilized more and more by institutions. They've added some scaling support for layer 2s. Now, some of these upgrades, the PeerDAS upgrade, and also the Verbal Trees, which is one that's a little bit over my head, but it's compressed data proofs. Efficiency, basically, is a way to read that. Those benefit layer 2s. Now, We talked about layer twos. Now, since I'm using a water analogy, let's imagine that this main river where we're checking pollution, we're now just doing samples, is still pretty congested. And so what oftentimes happens in those type of canals is they can dig sub-canals, or like you get it if it's a freeway, they can dig like feeder roads and side roads as well. That's what the layer twos are. The layer one is the main channel right there. At some point, layer twos, they might be processing, doing their own things, but they're built upon the Ethereum network. And as a result, they need to come back in to the main system as well. When they do that, of course, there are fees. And this upgrade, because of several different things that we've talked about already, it's a lot more efficient. And so those layer twos that are networked there to Ethereum, they suddenly become a lot more efficient as well, although they already, most of them are quite efficient as well. So yeah, overall, so this is scaling support. This helps the network just grow and mature. There's a lot more transactions per second available. You can look at the data out there. I won't bore you with that, but it's a really good upgrade. Now, if you're afraid that the system will crack and everything, they do these very deliberately, very slowly with a lot of rigorous tests. And so they had 3 different phases beforehand that were kind of testnet phases. They had, I believe, $2 million or so for finding and reporting bugs. And so like they make sure like that everything is secure and stable well before they launch. Again, that's coming in December 3rd. So makes Ethereum even more usable. I think that we'll continue to see the phenomena where we see institutions continue to gravitate towards Ethereum, not just as an investment like through BitMine, but also in terms of actual use, because the use cases are immense. Now, the last thing that I want to kind of show you is, again, looking at our Blockworks chart here. This is the digital asset treasury specific to Ethereum. And we can see right here that BMNR is continuing to be on top. They've hit that 3%. No one else is even close. SBET, they've done well, but you can see they've not really increased a meaningful amount. Again, BMNR is pulling away from the pack. They continue to add, in fact, a lot more than expected, which may also contribute to that 20% update that we've seen. But also we see the MNAV is continuing to actually separate. Now, there's an estimate here on this page that actually looks like that they're trading slightly under MNAV, but I actually think that they're over based on our calculations from earnings. So that probably needs to be updated on this page. So there you have it. That clean and simple. BitMine is benefiting, of course, from risk on environment due to the rate cut cycle that looks like it's going to continue. Now, if something shifts that and changes it, don't be surprised to see Ethereum and things connected to it like BitMine falling a bit in that environment. But the bottom may be in. Now, for myself, I am typically slow to add on a extreme green day like this. And certainly I did add some BitMine last week. I'm like, hey, this is stupid. Added some Ethereum as well. They were trading at ridiculous discounts. In my perspective, I still don't think we're going to have crypto winter quite yet. We've not seen the typical hallmarks. But this, we'll have to see whether this sticks or not as we head into the Thanksgiving. Of course, the market is closed a day in this week. And also it tends to be a lower liquidity environment, both for crypto and also for stocks as well. So in those environments, weird things can happen in either direction. Keep an eye on that. As for me, I'll just continue to hold, and happily so, in this company. And it's great to have at least a relief bounce, although I think it may be something more. Let me know what you think in the comments. Perhaps there's something that I missed.
Yeah, so I agree with the last part. I feel like it is a relief bounce, not really any kind of recovery. But this is Ethereum literally just as of 24 hours. This is the thing that was sitting around 27, almost 28, $28,000. And today we've seen it grow significantly, up almost 5.3% on the day. On the week, we've seen it drop even more. I mean, it was sitting, if we zoom out about a month, it was, what is this, 3,800, now sitting at 2,900. So it's fallen significantly, and this is why I'm thinking it's most likely some kind of relief bounce, and not an actual bounce that is driving the market in any way. It's more likely that the news around the Fed gonna cut, and the Fed has stepped in multiple times, just saying, hey, we're gonna actually cut rates. While Jerome Powell came out, that saying, December cuts are not gone news, where we're just gonna go ahead and cut in December. But I think that they're gonna cut. They're just trying to abate the market. They didn't want the market to be overheated. That's why they said that. Let's say they do cut rates. I don't think that's going to change too much. I mean, there are going to be more investments that are going to happen in the market. But overall, are we in a healthy market, stock market right now? It just doesn't feel like it with the amount of debt that is rolling out, and the fact that the entire economy in the United States is literally on debt. This always has been the case, but now it just seems like debt is growing significantly faster, just due to all this AI. Maybe you can call it hype, but let's say AI innovation. So these are the besties. They talk about some of the, the fallout with Epstein files, NVIDIA, and we're gonna go right into it and look at not the Epstein Tether booming business, and then we will go straight into where to talk about like crypto and everything else. Michael Burry, and they make a really good point on Michael Burry's depreciation issue around AI and AI infrastructure and data centers and chips, and so that is really important point to kind of pay attention at, just because that Michael Burry, he's been right a couple times, and now he's kind of pushing that idea that we might be in another we might be in another bubble, and so maybe we are in another bubble, maybe we're not. So that is kind of what they're going to be covering for that Michael Burry section of the video. And Michael Burry is saying, there's too much debt, there's too much circular financing, where you give me money, I give you the product, and I also then you buy my stock, and so the money is just going in circles, actually not going anywhere real. And a lot of these data centers are going to be depreciated, in the short term. That means going to impact things in the long term. So we're going to look at this and then see where they take it, and then we'll go from there.
I had dinner last night with Paulo Arduino, CEO, founder of Tether.
Can't wait to meet him.
Amazing guy. That is an incredible business.
What do they got, 150 billion in treasuries now?
It is an incredible, and here's why that business is incredible. This is what I learned.
You're talking about Tether, the stablecoin.
Tether, the stablecoin.
Yes.
There are 500 million people using US dollar-backed stablecoins from Tether all around the world, all over Africa, all over Central America, all over Asia, number one. Number two, his user base is growing by 30 million users a quarter. It's the financial inclusion that then ties back to US dollar hegemony is unbelievable. So if you think about
I buy a stable. Explain it to me like I'm an idiot who's never bought a stable coin.
Okay,
Just like every week. Which is what I am. Just like every other week.
So let's look at these businesses as roughly the same. There's Circle, there's Tether, there's World Liberty Financial. They all have a stable coin. What is it? Okay, so let's just say that Jason is a cash worker in India. Let's just use that example.
Sure.
He gets paid 100 rupees. And he's like, the rupee is constantly getting devalued. I'm constantly losing purchasing power. I want to swap that into a US dollar. So he would create a crypto wallet. And what Tether will say is, great, give me your INR, your 100 rupees. They immediately swap it to a US dollar. So now there's a US dollar and there's a token for that dollar.
Right.
I give Jason the token for that dollar. Now I have this dollar. What do I do with it? When I accumulate enough of these dollars, 50 billion, 100 billion, I can take that and I would invest it in treasuries so that it's completely safe.
US treasuries.
US treasuries. Now, if Jason decides to send it to you and then you redeem, I can sell a little bit, $1 of those treasuries I own, and undo the change.
And does Tether earn all the interest on the treasuries?
So I'm getting to this. So now, Tether and Circle and World Liberty, they earn interest on that. And so now when the number gets big enough, this number gets ginormous. Then what they do in Tether's case is they then reinvest this capital into all kinds of distributed assets. Bitcoin, gold, real estate. But what they also do is they now invest in things like financial inclusion in Africa. So he walked me through kind of a bunch of things that he's doing yesterday. It is an incredible business.
And so as a holder of the stable coin in my wallet, I'm not earning any of that treasury yield. I just have a flat dollar denominated or dollar protected stablecoin.
You have a pegged
to the dollar.
You have a dollar pegged stablecoin.
Right.
And that is sufficient risk management and risk mitigation for 500 million people.
Right.
and
They're not trying to get a 4% or 3% interest yield.
No. So now
they care more about not being in.
You're bringing up the big point, which is in the United States, what is the big fight now? The big fight in the United States in this thing called the Clarity Bill that is meandering through the House and the Senate is what should happen in the market structure. So meaning, if you, David Friedberg, is the one that gave me the dollar, and I am, for example, say Coinbase, and I issue you a stable coin, do I share that revenue with you? Do you earn all of it? Obviously, the banks, like the JP Morgans of the world, the Citibanks, they don't want that, right? Because that's their net interest margin. That's what happens today. You deposit money in the bank.
And Sachs said this on the program.
Citibank goes off and invests.
In the stablecoin legislation, they weren't able to give the stablecoin providers the ability to pay interest to consumers. They did that concession, but that will change over time. But the banks were able to fight for that concession.
The banks were able to fight for it. But then you have the emergent crypto companies who say, hey, this is like, let's find a way where we can do a sharing mechanism. How they hack around it is they do kind of sharing, but via this kludgy way called rewards.
Yes.
So like you earn rewards and you earn reward points, but it's not really what it should be. It should be that if you earn net interest margin, you should be able to share that. And by the way, you should be able to have different rules in different markets because, again, if you're in Kenya, the last thing you're probably thinking is, do I get the 4%? What you're more worried about is the Kenyan currency, whatever it's called, is about to depreciate another 60% this year. Let me just hedge that. And that's more than enough value. Anyways, I thought Paolo was incredibly impressive.
Well, I will say this.
Business is really impressive.
I have been super critical of Tether publicly. And they had a lot of challenges as a business. They were banned in many markets. They didn't do any audits. People didn't know what was in there. They've done an incredible job cleaning all that up. Now they are starting to going from attestations to audits, and they desperately want to be legal in America. In that legislation, they have 3 years to do it, and they have to then unwind being banned in New York, banned in Canada, all these places that got banned.
I have an offer for you.
Okay. I just want to say, let me finish my thought for a second. I just want to give credit to David Sachs. What we saw under Biden and what we saw with the anti-crypto approach that they took, and Trump in his first presidency was anti-crypto as well, that decade of anti-crypto led to a lot of people doing offshore stuff like Tether, a lot of shenanigans, and actually Sachs, who can't make it this weekend, he has now created a framework which is helping people do it the right way and taking out all of these questions. And Tether is example one. They were involved in the tethers have been the default for all kinds of
Do you know that for sure?
This has been in our congressional hearings. They have documented very clearly.
Let's not make the accusation if we don't know. What I saw yesterday was a very, very, very credible and thoughtful entrepreneur and a great business. The other thing, that I'll say is I'd like to invite you to come with me to the Tether conference at the end of January.
Okay.
We are going to
He's never turned down an invitation. Here we go.
Here's what we're going to do. We're going to fly together to El Salvador. We're going to
Salvador. We're going to do a tour of the prisons.
No. We're going to do an interview with Bukele.
Okay.
And then we're going to do an interview with Paolo, and then we'll fly home. Will you come with me?
If I can ask him any question I want.
Ask any question.
You have to go check out the prison.
No, I've been told you,
I'm not going anywhere near that prison.
You cannot go to ERCOT the first trip. You go to ERCOT the second trip.
I don't want to go anywhere near that prison, but if I can ask him any question and he'll be fine with it.
He's great, dude.
Yeah, I'm happy. I'm happy to go. Yeah, of course.
In any other world, he would have been in Silicon Valley doing the same thing.
Anyway,
$500 billion.
The other challenge they're going to have is when interest rates go down, these businesses are going to have to figure that out as well. But $183 billion in circulating USDT, that's a ticker symbol right now. 135 billion of that's in treasuries, and then another like 10 billion in Bitcoin and gold
and land.
And that means they're throwing off whatever 5%. They were making $7-8 billion a year just on the holdings.
I'm not going to tell you what the details are, but I've never seen a business like
No, they said it's a 500. The word on the street is a $500 billion market cap, which would be roughly 50 times their price to sales ratio.
Well, let me say it differently.
They're making 10 billion.
What's more, what do you think their profit margins are? Forget the growth quantum.
So
Oh, you only need 100 people to run the
interest-
business. I
Yeah,
mean.
if the interest is the revenue, it's probably 60-70% margin business.
Upwards of more than 95%.
It makes total sense because I mean, how many people
And you
do
know
you
what
need?
I thought last night at dinner? Here we are grinding away trying to get to 30, 40, 50%. It's so many of our
Don't get me
businesses.
started.
And he's like, yeah. It's
Well,
incredible. It's incredible.
The
Good for him. Congratulations.
Congratulations.
The good news about that is
There's a financial theory though that high margin businesses like that invite competition more.
Wow, that's literally where
this
I
is
was going,
This
yeah.
is where competition gets ground down.
Stripe bought the like a stablecoin provider. It's pretty well known. Stripe, Visa, everybody's going to have their own stablecoin. So Tether will not have the market all to themselves. And obviously, Jeremy Allaire and Circle is a very viable
Unfortunately,
competitor.
margin like that's only got one direction to go. So
Correct.
Yeah.
And if the
all right, let's talk about it.
yeah, and if the margin, if the interest rates go down, which is we'll talk about that as well, that's going to be headwinds for that whole space. All right, we've been talking a bit about about Brad Gerstner personally deciding to blow up the AI bubble and then destroying the stock market. I'm joking. Shout out to Brad Gerstner.
My gosh, this short Bitcoin thing has been a bonanza. Holy
Crazy.
mackerel.
And then-
wow.
yeah,
Is
I
it
mean-
below 90? It is, right? It's like 87.
I know it hit 88 or something, but I mean,
Watch out below. Let's see the price. Watch out below.
Okay, let's talk about NVIDIA.
So NVIDIA had a blowout quarter. Revenue up 62% year over year, 22% quarter over quarter. Net income 31.9 billion. That's up 65% year over year. They expect 65 billion this quarter. Jensen, friend of the pod, has said that they can't keep their product on the shelves. It's sold out everywhere. And then at the same time, Michael Burry, who has got the short on it, he's been mixing it up. He is posting in response, I think, to you, Freeberg, last week, making it a defense of the reasonable life of an H100, of these new chipsets, that NVIDIA sells. Is it 4 years, 5 years, 6 years, 7 years? When do they get replaced? When do they have a useful life and gap accounting? He believes, just to make it easy for the audience to understand, that major tech companies, big tech, are cooking the books in order to spike their earnings, that this is a house of cards, and that he's going to short Palantir because it's 100-to-1 sales price to sales ratio, but he's going to also short NVIDIA, et cetera, because of the depreciation. What's your thoughts? I know you've seen his comments. Freeberg.
I downloaded the gap depreciation rules. I was going to play Accounting Corner jingle, which a fan, by the way, sent me over the week.
Oh, great.
But
Super
I cannot
fans.
get the internet working.
We'll put
here
it in
is.
post. We'll put
Okay,
it in
here
post.
is.
I want to hear it then.
Depreciation and round trips too. Let's talk about some unearned revenue. Sharpen your pencils, let's see what you got. It's Accounting Corner at the All-In Pod.
Very nicely done.
Thank you for joining me here at Accounting Corner, and thank you to Roxana Martinez for that incredible jingle. I think we should adopt it.
Love it.
Love it.
Send in your jingles, folks. Jason
Gap
at
depreciation
allin.com.
rules, accounting standards 360.
Here we go.
Depreciation must reflect the asset's estimated useful life, not market innovation. The specific language.
Can you call us at 11:30 tonight and put us to bed?
Okay.
Wow, this is even. You found a corner even more boring than Science Corner.
Come on, people love Accounting Corner.
No, explain it because
Okay.
I want to.
Yes, it is actually important.
Under the GAP standards, the general accepted accounting principle standards. So you set a useful life, and you reset that useful life as you do a reassessment on when you're actually using that asset, not necessarily if there's a better asset that makes more value. So let's just explain this again. You make a big investment in property, plant, equipment, PP&E. And that investment you write down over a period of time that you as an accountant estimate to be the useful life of that asset. So if you're going to use a building for 20 years, every year you write down the cost of that building by 1/20th. You don't get to write it all down in the first year. In fact, what Burry is arguing is that if you wrote it all down in the first year, your profit would go down and your business would look worse. So when you make an investment that you can use over a period of time, unlike salary, when you pay someone a salary, you're paying them for the hours they're working that quarter, that year.
Yeah.
And so that money is an expense. It gets recognized as
Absolutely.
paid out that period. But when you make an investment in a building or a piece of equipment that you're going to use over time,
depreciate it, yes.
you depreciate it, just to go through that principle again. And so there's standards in GAAP on how do you recognize the depreciation schedule, what's the useful life. And the useful life is when you're actually realizing return value from that asset. Burry's point is incorrect. On Twitter, he said, the idea of a useful life for depreciation being longer because chips from more than 3 to 4 years ago are fully booked confuses physical utilization with value creation. That is incorrect. There is value creation because they are generating revenue from those chips this year, 6 years later. So there is, in fact, a useful life for that chip that has extended into year 6.
Now, let me ask you.
So it doesn't matter, and this is a part of the gap point that I wanted to bring up. So what he's arguing is you should depreciate it over, say, 3 years, which means you're doubling the cost every year, and then it's all written off in 3 years. But if you did that, to give you a point of example, in Google's case, their total net profit would come down by roughly 10 to 12%. So it's not like they're cooking the books and recognizing some massive delta in their profit by doing this. The difference between 3 and 6 years is roughly 12% of their profit. And they're still using these chips. And what Gap says is that only if the new asset, meaning the new chips, replaces the old one, then the old asset's remaining useful life has to be marked down and you take accelerated depreciation that year. Or if the maintenance costs spike, which means you have to spend money to fix the asset, which is not the case with chips. The third is if the throughput requirements exceed the old equipment capabilities, forcing early retirement. They're not retiring, they're still making revenue off the old chips. Or if technological obsolescence means that you're putting it up for sale, then you can, meaning you stop using it after a period of time.
Yeah, and if you put it up for sale, you would actually know the market value of it. You could take that from the depreciation.
This is almost textbook Gap, which is that if you're still using the asset after 6 years, you can depreciate it over 6 years or whatever.
I think this conversation lacks technical literacy. So let's assume you were Google, and let's just say that the equivalent of an output token was the equivalent of a link.
Right.
The first thing you would tell me is, hey, Chamath, not all links are made equal. Right? So for example, if you generate a link for a pharmaceutical drug, Google charges a price per click that's way different than the link that they generate that goes to Amazon to buy toothpaste, right? Now, for Amazon, it actually costs the same amount of money to generate that link. For Google, sorry, right? I think the thing that he needs to understand is he's equating this to energy, but the reality is that in AI models, the thing that we care about is what is that output token? What is the revenue that's being generated?
Revenue, that's right.
What is the revenue that's being generated by the output token? And ultimately, what he doesn't appreciate is that obviously Google and Facebook and Microsoft and OpenAI and X are not going to be in the business of generating negative revenue output tokens just for the sake of it. How do you know that? My wife got to the end of the internet this week. She launched X, put it on voice mode. She was stuck in traffic going from our house all the way to San Mateo and back.
That's like 10 minutes.
And she, no, it's 25 minutes up, 25 minutes back. And she said, hey, you know what? I ran out of tokens. Like it said, you can't use it anymore.
Oh, on Grok, you mean?
Yeah, on Grok.
Yeah.
Why do they do that? It's because they are very conscious of there's a certain energy output, there's a certain revenue potential, and then beyond this, they start to gate it.
Yeah.
You do it on OpenAI, you do it on all these things. So they are already keenly aware of the value of these output tokens. They know the revenue it's generating. Sorry, just one thing.
Yeah.
And then the second thing is, in the bowels of these organizations, everybody has completely rebuilt all of the decoder infrastructure. What does that mean? Before something gets to you, the user, there's all kinds of different manipulations that people are doing in the models, after the models, before the models, and all of that stuff has been rebuilt. So I think what he needs to understand, and look, in fairness to him, what I would say, what Gap needs to appreciate is when those laws were written, it's for a factory. It's for a turbine, and it's this static thing. It probably doesn't do a very good job of understanding the world of chips. But could he take a little bit of effort to call somebody and actually learn how this works? Yes. Is he doing it? No. So there you go.
Hold on. I think that the most important point of what you said there is, Chamath, this is a new asset, and it's a new space. There might be some companies that are like, we're going to lose money on this, and we're going to let you build, I don't know, Sora videos, right? And that's just going to be a money loser for 5 years as we get ChatGPT to 2 billion users. We don't care about it. And those machines are going to have 90% of their utilization in the first 3 years. And then for the next 7 years, it'll be 10% of their value. They'll be doing some small jobs in the background that won't be as important. Accounting isn't built to do this kind of refined depreciation schedule.
What do you mean 90% of their utilization? Because if they're still making
value
revenue,
to the consumer, so that if you theoretically think about the value of that H100, what value did the users get out of it? Well, the value today is like, I'm making goofy Sora videos that generate no revenue. It's all money losing. But down the road, that might actually be, advertising, and it might create some number of clicks. It might create some number of subscriptions. So we'll actually be able to attribute revenue to it. There's no way to look at these devices right now and to know, how much of them are actually generating revenue in the first 2 years versus the next 2 years.
I think we know now much more than we did even 6 months ago. How to value an output token?
And then what is the instructions we give to the accounting community on how to deal with that?
Dude, this is not that complicated. In the past, there have been efforts to try and change straight line depreciation, but your point of utilization, I don't think is necessarily the correct one. If they're still making revenue on that chip every year 4, year 5, year 6,
yeah. So even if it just
they're
makes
still using it,
$1 or $2,
it's still generating revenue for them. And I think that remember, the cost of electricity and the cost of running the data center is still it's still an expense in that period. So all of that shows up as an operating expense. So if it's generating negative gross profit, the market sees that. And I will say one more thing that I think is really important.
And they would turn it off.
GAAP standards.
They'll tolerate it to the point, and then they'll stop.
Look, there's no hidden information here. Burry's implication that they are cooking the books or hiding accounting is completely false, because all of the accounting is apparent in the cash flow statement and in the balance sheet. Remember, companies have 3 financial statements: an income statement, a balance sheet, and a cash flow statement. The cash flow statement reconciles the income statement and the balance sheet, makes the linkage, and it shows you all the cash that's going in and out of the company. And many analysts and many investors that are intelligent and do their homework will look at the cash flow statement, and they will see the CapEx, they will see all the investments going out, and they will calculate a number typically called free cash flow that will allow them to estimate the true cash generation of the business in a particular period and make an assessment of, should they be valued on free cash flow, or should they be valued on the GAAP standard of EBITDA? And the investor has the choice on how they want to value the company. And Burry is incorrect in thinking that they're hiding anything, because it's all there. They're following GAAP standards. And then investors make a market. And they all decide, what do I want to value this company on? Cash flow, EBITDA. Let them choose. And then the market sets the price.
I think we've given this guy way too much airtime. He's not very good at what he does.
I mean,
I'm sorry, but
come on the program, Burry. We'd love to double click on it.
Is there any other random person out there on the internet you want to take? Let's just use a magic 8-ball to generate numbers and names.
I would say that there's a lot of people who think highly of his analysis.
Doesn't mean they're right, and doesn't mean he's good.
Of course, but I think it could be a good conversation.
You know who we've never had on the pod? Stan Druckenmiller. Let's get Druck before we get Michael Burry.
Have both of them. I mean, why are we choosing here? Okay, Google released Gemini 3. It's pretty great. They regained the lead on most of the benchmarks. Polymarket now has Google at 89% to finish the year as the top LLM, and all the speculation that Google was going to have their search franchise absolutely slaughtered by ChatGPT has turned out to not be true, at least not this year, with their searches going up, revenue going up. But the big story is speculation around Gemini 3 being trained only on Google's TPUs, not NVIDIA's GPUs. Your thoughts, Chamath?
I think TPU is an incredible product. I'm biased, but I think it's an incredible architecture. This latest spin is very profound. But I also think that what we are quickly seeing is that there's going to be a highly fragmented layer of decoding chips that exist in the marketplace. Grok is one, TPU is one, Microsoft has a spin, Amazon has Inferentia. Facebook, I think, is apparently spinning up their own silicon. So we're going to get to disaggregated decode pretty quickly. The question is, who will win? There will be a bunch of different solutions. I think what's incredible about Google is, I don't know if you saw the stats, but they went from 8% share to 16% share of the entire chat market as of this last month. That's an incredible stat. On the enterprise side, Anthropic is just absolutely crushing. So what are we seeing? We're seeing a nascent market get created. We saw an allocation of traffic that basically favored one company over everyone. And now we're starting to see a sorting function and a classifier in all of these different markets. It's like breaking apart, right? There'll be winners in science, there'll be winners in enterprise level coding, there's going to be winners on the chat side. And where are the advantages going to be? On the enterprise side, it's going to be model quality. Anthropic is excellent. On the chat side, it's probably going to pivot around your existing inherent distribution.
Which is operating system, which is your browser, which is your phone, which is Apple and Google and Microsoft.
Yeah, the only thing that I would push back on what you said, though, is that I agree that Google has done an absolutely incredible job in defending search.
Yeah.
But I think what this creates is the setup where now they can cannibalize themselves versus having their market cannibalize for them. That's still going to be a very tough decision for Google to make, and it's going to happen.
I'm going to take the other side of it. I think what's going to happen is the AI gains in advertising targeting and the number of searches is going to go up. So while the revenue per search might go down, the number of searches goes up, and then the targeting goes up. So I'm going to take the other side of it. I think the search franchise is going to grow, and that Google's not going to lose to ChatGPT. And I think the big loser in all this is going to be OpenAI, because they started with 100% of the market, and they're only going down, and they're facing a Google firing on all cylinders, Anthropic and Grok beating them in the leaderboards pretty consistently. So I think the short in all of this, if you were going to put on the pair trade, is short OpenAI, which I think is overvalued and is going to go down. And I think I would be long Google, Grok, and Anthropic. I think that they're going to have many challenges. Also, I don't think the startup community, I'll just add this as my final thought on it, the startup community is not trusting OpenAI with their data. If you use OpenAI and you see them releasing products like Sora, if you were in the space of doing image generation, social networking, why would you trust OpenAI with your data? If you're doing a cursor and OpenAI has that product, they're not going to trust them. They're going to go with a model like Anthropic, which is taking a more neutral, we're not going to go to the application level. And they're also using DeepSeek and open source models, again, because they don't want to give their data and their advantage over to a person and enabling somebody who might compete with them.
Let me just
go ahead.
Make 2 comments.
Sure.
Number one is, I think what we will see over time is probably a differentiation of general purpose workhorses in chip architecture to more of these kind of special purpose chips that work well with certain models and certain applications. You can kind of think about inference in machine vision and robotics. You don't necessarily need an H100 to do that. You can use a purpose-built chip to do that in a way that reduces power cost, reduces ultimate kind of capital cost to deploy that in an edge environment. In the core data center environment, you may end up having models that are different for graph neural nets versus LLMs. There are going to be different chips that'll likely fit very differently with different architectures. So, I would say that the general workhorse is what we had, but now that everyone's making these investments, and you should expect that the investment dollars in chip design is only going to ramp up, not down.
Massively.
There's going to be differentiated chips for different markets and different applications.
100%.
And that's where there's a risk to NVIDIA. The other kind of...
Who do you think has the best chance of challenging NVIDIA?
So this is where I was going to go. The other black swan that I think is missing in the equation today, and my early prediction for 2026 is Huawei. Where I think that there's lithography technology that exists in China that is not publicly discussed, that is going to be deployed in Huawei and all these fabs that they're building in mainland China. And Huawei can create, at a very low cost, probably very high volume, and probably in reasonably short order, chips that can start to rival, for certain market applications, chips that might be expensive and long.
Give a timeline for that. 2 years, 3 years out? When
I think
start to see that have an impact on NVIDIA?
I think they start to make announcements. And by the way, remember chip architecture, and even Jensen's talked about this, is being redesigned with AI. So AI can design better chips.
Okay, so announcements 2026, impact 27?
Probably fair.
Yeah,
sure.
Okay, great.
Yeah.
Love it.
Is this what it'll be like when we have to be in a studio? When we get to this level of scale where our show actually matters? And we need to be in a studio?
We could be in a studio together, yeah. I mean, we'd have to...
This show would have never happened or worked.
Yeah, I mean, you have 4 people with actual schedules and jobs. It's not like we do this for a living. But
well, you do.
No, I mean, I invest in 100 companies a year.
Not well, but I'm saying you do it.
No, my
so
main job...
you could have carved out the time. The rest of us actually have jobs.
No, actually, I literally just got back from launching Founder University in
That's what I'm saying. Watching. That's the
Riyadh.
key word. Watching. You didn't say doing.
And
You said
launching
watching.
Founder University in Tokyo, thanks to my partners there. And
Did you watch
thank
that
for the
too?
plug. And investing in 150 companies per year and launching the 5th launch fund next year. So go to launch.co and you can email me
I got
anytime.
a distribution from you, by the way, recently.
Yes, good.
appreciate
that
it.
first fund is like 5-6x now.
Yeah, but it was on $8.
What's your top fund? Have you hit a 5x fund yet?
Yes.
Okay, great. So welcome to the club. Welcome to the club.
It was on 500 million, so it's like,
okay, great, awesome. Well, I mean,
it's
some
actually
people
more than a 5x.
Okay, great. I'm happy for you. I'm happy for you.
I should have just done it with all my own money.
That is actually the question. I mean, that a lot of people have. Do you feel you're a better investor when you're investing your money, or do you think you're better when you have the discipline of having to report into LPs? It's actually a good question.
My returns have been better when I've been by myself, but I think that there is something really valuable about working for other people, which it does keep you accountable. I mean, what's happened is my dispersion has increased massively investing on my own, which means I cut the losers off far longer than I would have if I was running a fund, because I think what I signed up for when I was running a fund was never lose money, ever, and return the money as quickly as possible and then run the upside. And so I would have traded a 7x with high vol for a guaranteed 3 and 3.5x, because I think that was my responsibility as the GP, because my LPs were Memorial Sloan Kettering, the Mayo Clinic. I wanted to give them the money back because they have programs.
Right.
And it's not my job to hold the money back. With myself, I can keep it out, so then the ups are higher, but then the lows are also lower.
Yes.
Because some of these things just get annihilated. Like, look, like relativity space, I took a $400 million goose egg.
Yeah. And this is the challenge, Friedberg.
Eric Schmidt shows up and he's like, here, it's $1 billion, pay to play. And I'm like, okay, I'm not going to do it.
Yeah.
So go.
Friedberg, you had a venture studio for a little while. You had to deal with outside investors. Now you're obviously in the driver's seat, CEO of Ahalo. You also had that pressure. You have to answer to LPs. Did it make you better at the job, or did it make
No, I still do. Same investor. My venture studio owns the majority of Ohalo. So it's our biggest driver of value. So I'm spending all my time on Ohalo. That's kind of my.
But do you run the production board still?
Yeah.
Like, are there investments that you
I'm on
do?
a few other boards.
But no active investing.
I'm not
no
doing
new-
any new investing. Actually, a lot of folks moved into Ohalo or moved out to stop doing new investing. And then slowly we're kind of, as we have a liquidity event, we'll do a distribution. But the goal is for TPB to end up being a holding company with just Ohalo in it. That's where all the value is going to come from. So we actually just did a distribution, and then we're going to do kind of distributions as we have other kind of events for the other things that are in our portfolio. And then we'll just focus on Ohalo.
When you came into this venture studio model, did you anticipate, which is what most people do anticipate with venture studios, that you'd have one breakout and you would go all in on
No,
that?
I was delusional.
Okay.
In 2011, 2 years before I sold Climate Corp, I started a company called Metro Mile. I was the chairman of the board of the company. I hired an outside CEO, fired him in a year, promoted the CTO to be CEO. For years, I worked with him as the chairman of the board. I invested close to 10 million of my own money in this company, spent years on it. It had raised a Series B, a Series C, Series D, was doing great. I'm like, man, this is awesome. I can be a chairman, not a CEO, run these companies. This goes great. Scaled to like whatever it was, 100 million of revenue. I started Eatsa, which, as you guys recall,
Yes.
was this quinoa fast food restaurant. I put
Robotic as well.
Robotic,
You were way ahead of
2015.
your time. Yeah.
I put 3 million of my own capital in the business, and then I had a CEO run it, and then we raised outside money, which I was not planning to do in that business. And I'm like, man, I am so good at starting companies and being a chairman. This is what I should do. And that's what led me to start the venture studio. Both those companies ended up being net negative returners for me. And over time, many of the other projects that I was a founder of, but chairman of, didn't succeed financially. And over my years being on boards, I realized how frustrating it was to be on a board where you would tell a CEO a bunch of stuff, they wouldn't listen, they would do whatever they wanted to do. I was frustrated pulling my hair out, watching them do things I wouldn't do, not doing the things I would do. So after many years of failure after failure, I realized, this was the moment where we had this amazing series of outcomes at Ohalo. And it was a research project for several years. We put close to $40 million into this project before these results started to come in. I'm like, holy shit, this is the game-changing business of my career. This is the power law. And that's when I made the decision, I'm gonna go all in on this and I'm gonna run it as
How'd
CEO.
the LPs take that and how'd you communicate it to them?
Everyone was very supportive and very active. They were like, this is exactly what we always hoped you would do, was to find a winner. And I never thought that that's what I would do, because I swore, after I sold Climate Corp, I swore I would never be a CEO again. It's too stressful. It was damaging to my health. It's like overwhelming. I'm so into it. I cannot stop building the business. It consumes me. Everything about it, I have to win. I have to make the business an ultra success. It consumes me. And I knew that it would happen to me again, and I've got kids and all this stuff. So I had to really like dig deep to make the decision to do it. And actually, you know what changed my mind about this was I saw the movie Oppenheimer in IMAX, and I left that movie and I cried, and I realized I wasn't doing what I should be doing with my life by being this board member who was useless. I'm like, what am I doing here? And I said, I'm gonna make this, and I'd been thinking about this, and I'm like, that's it. It took me over, and I made the decision to step in as CEO. So yeah, the LPs, the investors were all thrilled because they had all said, like, we hoped you would run something one day, and then more capital came in, and we've been running Ohalo it's been 2 years now, this month, that I've been running Ohalo as CEO. And I'm really happy I did it.
That's incredibly inspiring. Chamath, would you like to mock Friedberg for crying at Oppenheimer in any way?
I saw you queuing it up. He's queuing up, he's like...
Yeah. Great movie, by the way.
I cried when I got married. I cried when my kids were born.
Yeah, he cried at Oppenheimer. He's like, oh my God, he split the atom.
Do you ever ask yourself, what did I do with my life? Like, do you ever think like, hey, the impact I thought I would have in my life, that there's a missing piece to that? There's something that I didn't accomplish that I always expected I would, that there's something I didn't achieve as a person. And then you see these kind of extraordinary outcomes that others do, and you're like, man, what am I doing with my life? What am I doing?
I think that's a pretty profound insight you had. And it sounds like you made the right decision. All right, next up on the program, one of our favorite human beings. You know him from High Stakes Poker. The one, the only, the madman of the poker tables and the mensch in our poker group, Alan Keating.
Alan Keating.
What's Good
up?
to see
Thank you
you,
for the
brother.
kind introduction.
Have a seat. Have a seat.
What's up, brother? How are you?
You're sitting next to me.
Oh, good.
Come on in.
Now, Alan,
just like at dinner last night.
Yeah.
You were to my right.
Let me introduce.
You were not at dinner last night.
Hold on. Let me just do a proper introduction so the audience understands who Alan Keating is. We'll get to it. Alan Keating. Just type that into YouTube. Watch a bunch of Alan Keating clips. Alan, very famously.
Paraforce Keating. That's what I call it. Paraforce.
Alan Keating.
I saw that. That was incredible. That was legendary.
Alan Keating ran the high stakes game here, the elite big game, for many years. Then he started investing in companies. He was the seed investor in a little company known as Polymarket. And he's gotten into our friend group. I don't know how many years ago, Chamath, you brought him in, and he fit right in, and we started hanging out 10 years ago. And we got to know him. In that time, he also started to play high stakes on TV, stopped running the big game here in Vegas. And on TV, you're known for playing way above the rim in a way that, to call it non-traditional, would be an understatement. Take us through...
No. That's not true.
Okay, go ahead, Chamath. You wanted...
Yeah, look.
Yeah. Chamath will explain your career to you. Go ahead.
Keating,
listen up.
Keating at his core is an exceptional player. Not a traditional, like, you'll see some of the other guys who are more solver oriented, but Keating has incredible live reads. Kind of like a modern, younger generation of Helmuth. I mean, Helmuth has good live reads, but now, he's like an aging horse. We're going to have to...
Yeah, he's older.
He's going to send him to the glue factory soon. But Keating is in his prime, and what he can do is he can soul read people, which when you're playing at the high stakes, honestly, that's all that matters, because you can't play solver-based. At the stakes in which we play, you cannot. You're just going to get run over. And that's why you see him being able to do these things, because everybody else steps into the game. They're like a deer in the headlights. They're so afraid. And he is very comfortable.
Yeah.
And so he can see it and he can pick people off, like when he picked off Doug Polk with a 4. How does that happen? It's because he can soul read people and he's attuned to play this game.
Keating, true or false? Can you soul read people?
Yeah, I think I'm navigating fear on the poker table better than most. So I think when people are, afraid, they tend to give things away or get scared or act different, and I try to
That's sizing.
get myself
the
comfortable.
problem with the Doug Polk hand was that he up the bet sizing on the turn.
Yeah.
He ships the turn, you fold.
Yeah.
He puts himself in a horrible situation where he's B40ing the river. I mean, you just soul read him. And it was great. It was incredible.
There were a few different tells that I wonder
incredible.
if I should delve into. But
give up your tell.
Break it down, because these guys, most of the
by
people.
the way, I think this is important because a lot of people think poker became solved because of computers and AI, and everyone uses trainers now. But to your point, to Chamath's point, like there's still at the core of the elite level of the game, very much a tell and psychology reading kind of.
We'll get Nick to play picture-in-picture this hand. How big was the pot in the end? Million something?
No, probably 600.
700K.
Yeah.
Doug Polk, who was a phenomenal heads-up player, had ace king.
Like the best in the world.
You, like a ding-dong, had
4-2.
4-2.
It's playable.
To 75,000
somehow ends up in a pot.
It somehow ends up seeing a
It beats one hand.
raised flop.
But it was like what, like 150 on the flop?
75 pre, 35,
pre.
75 all in.
Yeah. Okay, so take us behind the hand. Like, what's the read?
And why are you playing 2-4 to begin with? Like, why don't you explain that to the
he was a
people
big blind.
watching? Yeah, but explain the thinking there, because a lot of people are trained.
Let him talk.
A lot of people want to, like you said, put everything into a solver and reduce something into a vacuum and navigate that situation. And I don't really have a passion for that. I have a passion for like what's happening in this moment, what's happening with this person, what's happening with me, what are they perceiving me as? And in that moment, Doug had gotten some confidence around a couple hands, and there was a player in between that I knew he didn't think much of his hand, and he didn't think much of my hand, and it seemed like an obvious situation for him to pull it away from me. And I thought about re-raising all in pre-flop just to simplify it, and I think that was probably a better way to do it. But at the same time, I do a lot of things for the fun of it, and I thought it'd be a little bit more fun to get him in a spot later on, a couple streets down, where I could bluff him out or call him down. So,
and did he have a tell on the turn? Or
yeah, he goes 75,000, like kind of directly, and about an hour and a half before then, he had the same tonality, same cadence, and he was just airballing the situation. And there was just a myriad of things where it was like, that might be something, I'm not sure. That might be something, I'm not sure. Well, here's a lot of things that might be something, and I'm pretty sure that the combination of them leads into this.
What happens if you call situation, and he shows pocket jacks or something? So, and then do you, like in those spots where you call off and you lose, how do you process losing $700,000 that way? Do you think this is so stupid, why did I do that? Or are you saying, what's the self-talk? What's the internal monologue?
I guess I don't know where it came from, but I wanted to always kind of have a sense of humor around whatever happens to me. The things I can't control, the things I can control. If I put myself in a spot, I've gotten to a point where I can immediately recognize how ridiculous what I just did was and kind of laugh about it.
And be okay with it.
Yeah, sure.
So you're forgiving yourself during the hand?
Yeah, there'll be like an internal part that's just like, yeah, of course, that was stupid.
This is so dumb. Why am I doing this?
So dumb to do that.
So to be able to pull off the hands you pull off, you have to have a I don't give a shit kind of attitude about this is all a game. I don't take it too seriously, because that's where fear comes from.
It's about mastering the fear. Yeah, I think I just recognize that people make bad decisions when they're scared, and that's why I like.
But sorry, say that again. Mastering fear. You put in reps. How do you put in reps to master fear? Because that extends to many other things in life.
Right, absolutely. Like we talked about this in investing, and different strategies about how big of a bet you want to make relative to your bankroll and venture and stuff like that. Well, I like making the bet where if it doesn't work out, I'm in a little bit of trouble.
Right.
You like to feel the pain.
No, you like that it feels real.
Yeah, it's a motivator. It's something that drives, and I like poker. I'll put myself in the same type of situation.
Just like 2 years ago, Keating calls me. He's like, "Hey, this is like about portfolio construction and like a specific company. We won't say the company. We talk for a hour, and I'm trying to give him my best advice. Look, here's how you structure it to minimize volatility. take some of these chips off the table, do this, do that. He goes, I really appreciate this. Calls me 2 days later. Yeah, so I doubled down on this thing and I just put it all online. I was like, okay, great.
Okay.
Throw that
Modern
out the window.
portfolio management
Throw
out
that
the window.
You don't know this, but I've tripled down.
Exactly.
Well, here's the
What
interesting.
was your purpose in calling him then? So if you felt that
Yeah.
was where you were going to go, why are you checking it? Were you trying to check your sanity, or like what were you doing there? Like, why do you check?
I'm inviting him to the deep end. I'm saying.
Want to come with
No,
me?
you're talking about me?
I'm asking why he called you.
Oh, why he called
I thought you were talking about Doug Polk.
No, I'm asking why you called Chamath in that situation where you're going to double down, triple down. You really don't like. What was the?
I have access to someone that's like infinitely smarter than me at the thing that I'm trying to understand.
You're jumping in the deep end.
Yes.
Why are you asking him like, should I jump in the deep end first?
Because I want to earmark like all the reasoning, right? I'm trying to understand everything about this decision because I'm going to live with the outcome of that decision no matter what, right? So I want to remember his take, my feelings, other people's thoughts, and I want to put that into like a little bit of folder that I could come back to.
You unconsciously, or you've discovered something which is referred to as super forecasting in like behavioral sciences, which is if you write down and you understand all the permutations of your decision making, and then you reflect on it years from now, you'll just be better at decision making. So that's actually what you're doing. And I think it just comes natural to you. And you were going to say, when you thought the question was about the Pocan, about inviting him to the deep end.
Yeah.
Unpack that concept of saying, hey, we both know that this hand's out of control. We're in the deep, dark waters.
Right.
There could be sharks in there. Explain what you're doing. Because I've been in hands with you where I feel like you just dragged me out to the deep water, where I've got jacks or queens, and then all of a sudden I'm going to be playing for my entire stack, and they don't feel good anymore, even though I have an overpair to the board or whatever it is.
Yeah, that's a great point.
I just think there's some purity or beauty in the chaos after you get past where everyone's prepared. And I'm interested in that space, and I have no interest in the space that everyone's prepared.
Everybody's got a plan until they get punched in the face.
You remind me of Alex. You're the Alex Honnold of poker. Alex Honnold is the guy who.
Oh my God!
Oh my God!
What is this? We're in Vegas.
Uh-oh.
We're in Vegas. It's time to play some poker. Time to play some poker.
And you asked
you see?
Oh my God, his bestie. And look, his This is Kashmir. And look, guys, Helmuth decided for this special occasion with us here taping All In for the first time in Vegas, Helmuth decided to wear a tracksuit that's only 12 years old. It was one of his newer tracksuits.
A few years ago, at Helmuth's birthday, we each chipped in, I think, $3,000 to buy him a new wardrobe.
There was like 60, it was like 70,000 in total.
Yeah, there was 20 of us. We each put in $3,000. We put in
remember the whole rack of clothes, and he hasn't won a single thing.
He showed them to the poker room. This shirt you guys bought for me. I will say this: between that wall and that wall, you guys gave me all new.
All those clothes? Did you sell them?
Ton of clothes. No, I gave them to my sons.
Oh, okay. All right. Sit down. Phil Helmuth, please sit down. I got to close the show. Hold on.
And then we're going to play
everybody
poker
stand by.
Supplemental.
Yeah. 3, 2. All right. Alan Keating, you're a mensch. It's a pleasure to know you. Great to play with you. And we're going to have some exclusive content on our YouTube channel of the besties playing poker with incredible professional poker players like Jason Kuhn, Alan Keating, and then I think Phil Helmuth might show up.
Let your winners ride.
Rain Man David Sack.
And instead, we open source it to the fans, and they've just gone crazy with it.
Love you, West. The Queen of Quinoa. Besties are back.
That is my dog taking a notice in your driveway.
We should all just get a room and just have one big huge orgy because they're all just useless. It's like this sexual tension that they just need to release somehow.
Wet your beak. Wet your beak.
We need to get merch.
Besties are back.
Hey guys, it's me, Josh Brown, and we are live from the compound with a first-time, very special guest. I'm so excited for you to meet Charles Lemonides. Charles founded ValueWorks, which is a hedge fund and separately managed accounts. Is that the best way?
Yep.
Okay. Separate account strategy and hedge fund, ValueWorks, with the goal to broaden availability of his conceptual value investing discipline in the retail and institutional investor communities. Charles leads investment research and portfolio management at ValueWorks and has final authority for all investment decisions. Charles, welcome. So nice to have you.
Thank you so much for having me. I love being in your compound over here, and the space is great.
It's a pumpkin compound these days. We're super excited to have you. So you and I have this in common. We both are very excited about one particular eVTOL stock, and that is Joby. And you're back from the Dubai Air Show, which took place last weekend?
Last week, Monday to Thursday.
Okay.
Incredible air show. I mean, it's just a massive event.
Is this the big one? This is the big annual event for the space?
There are a couple. There's one in England, there's one in Paris, and there's one in Dubai. I think those three qualify as the big ones, and this one definitely is the same scale as Paris, which I visited last year.
How many people go to the Dubai Air Show?
You know,
what does it look like?
It's huge. I think it's 50,000, 100,000 or something like that. It's a lot of people.
Okay. And how many people from the American investment community are there, would you say?
It's thousands. It's thousands because it's a huge range of aerospace companies, from tremendous amounts of defense stuff to commercial jets to now increasingly this advanced air mobility space, which is small for that air show and small for the scheme of things, but growing.
Okay. I want to share with you what Andres Shepard, who's been on the show before, had to say about Joby at the air show. And then I want to have you react to it because you're long the stock, I'm long the stock. I think we're both pretty excited about the potential, even though it's relatively early. But this was what Andres had to say when he got back. Joby was the clear winner from the eVTOL OEMs, in our opinion. The company was the only one to conduct live piloted test flights while at the air show, which Joby carried out once a day throughout the week. More specifically, Joby's completion of a 17-minute flight from Margam to Al Maktoum International Airport marked the first time an eVTOL conducted a piloted point-to-point electric air taxi flight at the UAE. And there's a lot more here, but that seems to have been, a lot of people are saying, the highlight of what they saw from this space.
Well, yeah, it's really interesting because it's become a really deep ecosystem. There are a lot of these aircraft or flying machines on display. China, Europe, multiple US. But you're right, there was only one that actually flew their flying machine and is much further along than everybody else. I mean, you look at everyone telling stories and having models, and they're great stories and they're great models, but one of them's flying and the others are not.
Yeah. So Joby, to me, seems advanced in a lot of ways. In that way, that's obvious. They have something that's actually working now. But they also made an acquisition of Blade, which is the helicopter. So they got both ports, the Hudson River, the East, and then the East River. And they got some revenue. These other companies don't really have revenue yet. And that makes it stand out to me.
Not only does it have revenue today, but it has the infrastructure in place that when these flying machines are ready, they're going to just swap them in and the helicopters get swapped out. And I think it's going to be a big game changer because these things, one interesting element of being at the air show is that the jets are going by and they are making incredible amounts of noise.
They're so loud.
So loud.
Yeah.
And then you see this little Joby aircraft come into the air and you hear some jet noise in the background, but it's the jets from far away. This thing makes no noise, and that's going to change people's willingness to have it showing up in their neighborhoods.
What is the name of the craft that Joby made? Is SR4 or something? It's a little bit like a Star Wars droid. I feel like they need a makeover.
I think their name is one issue. I think the bigger issue is the whole word eVTOL. I mean, I don't know who knows what that means.
Well, you keep saying flying machines, and I noticed that. You don't like eVTOL.
eVTOL, I don't know. First of all, I've been following this company for 5 years. I mean, it's electric, vertical, takeoff.
And landing.
Well, how's that? Oh, Al, tell
Take
what?
off.
Take off. Okay, fine. Like I said, it's not a great word.
I don't love it. I agree. I think it's important though that as a category, it's called something. It's not a quiet helicopter.
It's not a helicopter because it glides.
That's right.
You know, helicopters, the engine stop, the thing falls. It has a wing. It flies like an airplane.
So we'll throw some pictures up, but for the people that are listening to this and not watching, the vertical takeoff is important because it doesn't require an airport to get in flight. So it lifts like a helicopter. 6 rotors, not one. Much quieter than a helicopter. Double redundancy. If one of those rotors goes down, there's still 5. If 2 go down, God forbid, there's still 4. It'll remain aloft. The fixed wing is what differentiates it from a helicopter besides the sound and the singular rotor, meaning it flies like a plane when it's up in the air, and then it can land back down.
Which makes it much more fuel efficient when it's flying like an airplane relative to a helicopter. And helicopters are loud not because their engines are loud. Helicopters are loud because the size of their blades is so large that physics just means when a blade is rotating like that, it makes a lot of noise.
Yeah.
It's as opposed to zzz.
Well, I spoke to you about this the other day, and you pointed out a lot of the helipads that used to be in cities like Manhattan have been decommissioned because the exhaust fume is blowing into the buildings, like into the AC. Buildings don't want, right? So this is like an answer to that.
There's no pollution coming out of it when it's running, right?
It's electric.
It's electric.
That's
There's
the E in eVTOL.
Right. And then the bigger issue is the noise also. As big an issue is the noise.
Okay.
You know, there are protests, Stop the Chop.
Yeah.
You know, and they went to protest when Joby came to New York, and Joby was smart enough to invite them all in and say, listen to this thing, it's not loud.
Okay.
And I think it won people over.
So the blade business, my understanding is it's $20 to $25 million a quarter, right? Almost a $100 million annual run rate.
Yep.
So that fundamentally sets this company apart from, I think, the other 3. One is Vert, V-E-R-T, is Archer, and now there's a third one just came public, Beta.
Beta is different because theirs is a more normal takeoff and landing airplane.
Okay.
It's electric. It's got an electric engine, and it has the capacity to put rotors on its wings so it lifts and lands. But right now, what they're bringing to market is an electric airplane.
Okay, so this is...
But there are a bunch of other ones, too. There's Eve, which is... and Whisk. Whisk is, I think, if I'm not mistaken, backed by Boeing, and Eve, I think, is Embraer. And Eve will probably be a competitor, you know, in the relatively near term.
Is
I think
Eve European?
It's Latin American.
Latin American.
Well,
Okay.
yeah, Embraer, which is a Brazilian company.
Okay. So you're at the show. Does Joby get more attention than the others?
Well, it's interesting. There's a large area with all of these flying machines indoors, and there had to be 10 or so of them.
Prototypes.
Yeah, they're basically all models, and Joby's is a model too. The one that Joby has there, I don't think the one inside flies. But there are a lot of different ones. And you walk around from booth to booth, and they tell the story of how this is going to be something that's important. And I think seeing so many of them sort of validates that this is going to happen. But like we said, Joby's been at it for much longer than anybody else.
Yeah.
And, it has something that's flying. They're building-ish one a month right now. They've sold a couple to the U.S. Defense Department that have been flying. They do flights, basically every day. This thing is in the air. And it's probably only a year or so away from being government certified.
So let's talk about that. One of the things that I think is a catalyst coming up in the next couple of months is these companies start to join this EIPP, which is like sort of like they will work hand in glove with the FAA and share information with each other to start working these into the overall ecosystem of flying things.
Well, right. So the Trump administration is making an effort to create use cases for these flying machines, and that's where I think the biggest advantage Joby has relative to its acquisition of Blade. Blade takes reservations online. You go to the heliport, you pay your $175 or $250. It takes you to the airport, and it's a great experience. You don't have that setup in many other cities around the country. I mean, New York is pretty particular in how well developed that is. And the thing that's important about that is not simply that New York is developed, but that the people who developed New York are the people now at Joby getting ready to develop the same thing in other cities.
They have a customer base.
They have a customer base, and they have a management that knows how to put the infrastructure in place.
Right.
How do you lease the space? How do you get people coming? How do you get people going? How do you do the reservations? How do you when you land at the airport, how do they get to their airplanes? All those details, Blade has already worked out.
Right. That's not the high tech part of this. That's more like the logistics and the people moving part of this, which is equally important.
Right. So there are two parts, right? One, you have to have the machine that flies in the air and carries people. But then you have to have, and then you have to be able to make a lot of them. And a lot is something we should talk about in a second. And then you have to, and there are plenty of people, I think, that will buy these. I mean, there are going to be thousands of people that are willing to buy one of these things.
You say people, not like people, but organizations?
I think it's going to be a wide range. I'm sure there'll be plenty of deep-pocketed folks who fly airplanes and helicopters that want one of these. I'm sure half the mega yachts around the world would rather have one of these on board than a regular helicopter. But I don't think that's where...
That's not Joby's business.
That's right.
Selling them. Their business is
it's going to be operating them.
Okay.
And the reason that's super important, to my mind, is that these things are going to be in short supply for the next 5 years. Even if 2 or 3 companies have them available to be sold 3 years from now, Joby will be lucky if they can make 200, 300 a year, 2 years out.
Yeah.
The other guys are going to be way behind that. There's really hard to see how they won't be way behind that. So the thing that limits you then is if you're selling them for whatever it is, 5 or 10 million each, and you're selling 200, and then you go to selling 220, your revenues go up by 10%.
Right.
But if you're operating 200 and you're making $5 million, generating $5 million of revenues on the operating 200, and the next year you're operating 400, then your revenues have just doubled. And then if the next year...
Is that what you're modeling?
That's exactly right. I'm modeling...
So say it again. Let's say there's 200 of these in operation.
Listen, I think a year from now, there are going to be a dozen of these in spots around the world.
Yeah.
Not really flying and generating revenues 12 months from now, but I'd be surprised if they don't have one in New York City, if not 12 months from now, 15 months from now. Not doing any real work, but sort of prepping to see how it fits into what they have.
It seems like they're going to be adopting these internationally faster. So there's a 6-year exclusive agreement between Joby and the RTA for air taxi services in Dubai, and plans for a commercial launch of that in the second half of 26. So let's say that happens smack in the middle of 26, and it's at the Dubai airport, and it's going to fly to the mall. It's going to, it's got a couple of destinations that it'll take people. That's a pretty big deal. And it's like a year from now.
And it's a year from now. And it's like science fiction, and it's unfolding like here and now. And look, I first became aware, this company first went public 5-6 years ago. And at the time, they got a lot of enthusiasm because it was going to be the next Tesla, and it was, wow, gee whiz technology.
And we were in a bubble anyway.
Right. But, when I looked at it back then, it was like, wow, this is a long way off.
Right.
Okay, yes, this is going to probably happen, but decent idea, but it's a long way off. 5-6 years have gone by, and you are an awful lot closer. And now it's like, you know, a lot of the early enthusiasm, people got disgusted that, you know, it lasted, you know, they lost money all the way down. But now I think you're getting to the place where the reality is happening, and it's really right.
These stocks were caught up in that whole mania SPAC bubble with all the crypto stuff that blew up, and it was just like too speculative. I made the argument that they probably shouldn't even have been publicly traded. All this, it's like a fluke of history.
Well, they had a chance to raise money, and you know they jumped through that window and they raised the money and they put the cash on their balance sheet and they've spent it building out their businesses, but it was too early for investors.
Okay, so Joby is $12 billion market cap. They've raised money on several occasions. It seems like they have enough to start production.
For sure.
I'm sure they'll raise again if the stock price gets significantly higher.
We'll see about that.
You're not sure?
I'm not sure. I mean, I'd be optimistic that, you know, as they start ramping production, they'll sell a handful. And then, you know, it wouldn't be surprising to me if they sold them and leased them back and didn't actually own all of them. But, you know, from a capital allocation perspective, I wouldn't be, because look, once these things start operating, they're going to have a market value and they're going to have an intrinsic value. And so, you know, if they are spending $3 million on each one and, you know, and have 200 and then 400 and 600, that's a lot of millions of dollars of capital tied up.
Okay. People say to you, why would I invest now? Why wouldn't I just wait until they actually launch commercial service in Dubai, for example, or in United Arab Emirates, Saudi Arabia, whatever country lets them start up first? Why wouldn't I just wait and see? What if it's a disaster?
Well, there are going to be hiccups, and the stock, I'm sure, will correct by 30% a whole bunch of times over the next 10 years.
Yeah.
The question is whether it corrects at 30% from today's level or from
after
2 or 3x
tripling.
higher. Right. And, you know, I look at that stock today and I look at the chart of it. I'm like, wow, $13, $14. You could easily see how that doesn't hold and it gets down to $10, $11.
I feel like I want it. I don't own enough of it, so
I do.
I want that.
I do, and but the reason I do is because it would be ridiculous to miss the move from, you know, $12 billion to $50 billion equity cap because you wanted to get it 20% cheaper. I mean, I made that mistake in Carvana a bunch of years ago, and I kick myself every 6 months about how stupid that was.
Okay. Do you see this as being Tesla-esque, just in terms of Joe Ben, like the founder? He's still there. He's considered to be like sort of the revolutionary around which the whole ecosystem revolves. Like, do you see it though, that possibility here?
I don't. I mean, people talk about the comparison to Tesla all the time.
Right. I hear a lot.
There are some similarities, but yeah, I think that the depth of organization behind the founder is very different in the case of Joby. I mean, they have real corporate partners that are very committed to them. And I don't think it's just his quirky, driven style that makes it happen. I think Musk was very smart in understanding that electric posed a tremendous advantage. I think this fellow was really early in making it happen. And I think this guy is an important leader for the company. But frankly, I think this company works, you know, even if you don't have a charismatic CEO.
Let's talk about the corporate partners. I think Toyota owns 15% of the business.
A good chunk.
A good chunk. So they've invested directly, they've acquired shares, and they're going to be the manufacturing partner that enables them to build 200 of them or 400 of them.
Well, they have given up cash money to be invested, and they have management on the board, and they are giving guidance on how to do the manufacturing. But Joby is really going to be the manufacturer, and that's different than Archer. Archer is planning on subbing out the manufacturing to Stellantis. Stellantis. You pronounced that one right, not me.
Right. Chrysler.
Yeah, Jeep.
Right. Okay.
Or Fiat, maybe.
So Joby is building themselves.
Joby is building
in California.
themselves. California and Dayton, Ohio. And
Yeah.
they have a pretty decent sized facility in Dayton, Ohio, and they're starting to actually use it to manufacture the blades, because there are a lot of blades that go on every one of these, and they're pretty sophisticated and specific.
Yeah.
So they'll be ramping up manufacturing of a lot of blades.
Okay.
In
What-
Dayton.
One of the other similarities here to Tesla that I think is worth considering, and I'm sure you have, I follow smart money. I like to pay attention to people who have taken big swings that have both failed but also worked. One of the largest equity shareholders in Joby is Bailey Gifford. And this is big Scottish asset manager that took a big swing on Tesla very early on and built like a $30 billion stake as a result with a lot of profit. And I'm curious if you pay any attention to
how
that.
I know Bally Gifford?
How?
I know Bally Gifford because, I'm a value guy and I look for short ideas. And every now and there are a lot of
You use their portfolio to look for short ideas.
No, what happens is I look for I find something that's really super richly priced.
Yeah.
I'm like, yeah, it's really richly priced, but they're really well positioned. Oh, and frickin' Bally Gifford owns a slug of it.
Oh, so that will
It's like,
caution
okay,
you.
that's
Okay.
exactly, I'm out. I'm out on the short side. when
Okay,
they
so it's
help me.
meaningful to you. I think they have a 6% stake or more.
Yeah,
That's
they're
meaningful
really
to you?
smart investors. They're,
Okay.
Listen, they're smart investors. I think that's a really positive sign.
John, can we put up some pictures from the Dubai Air Show featuring Charles?
All right.
All right. So walk us through what we're looking at. This is what?
This is your little aircraft indoors.
This is the SR4, the
Yeah,
Joby.
this is, yep.
Okay.
This is the one they're going to be making. This one probably doesn't fly, like I said. I don't know for a fact, but it doesn't matter. This one's the one indoors. The one outdoors does. Oh, there we are.
Hey,
Sitting
I
in
know,
it.
I know that young lady. Is that Lynette Lopez?
That is my associate, Lynette Lopez.
Isn't she fabulous?
She
All
is
right.
one of the best ever.
All right. So where are you guys? You're in the cockpit?
I am at the controls.
Okay.
On the far right is Teresa, who is head of IR. Then we've got Phil and John in the back seat, who
Okay.
traveled to
This
Dubai.
is how
with
I
us.
know this version doesn't fly. Because you're at the controls and Lynette is behind you.
Yeah,
And
yeah,
that is
no.
not that is not that
No,
is
not
definitely not happening. Okay. What else do we have? This video?
Okay, so there you go. There's this little thing
Look at
just
it.
buzzing around.
Oh, it's so cool.
It's so cool.
It's like a it's like a
and-
dragon in the sky.
Yeah.
Like people aren't
Yeah.
it's silent.
And it's
Maybe because we have the video on mute, but that's
Even
one of
if
the
it
big parts
weren't.
of it.
Yeah, no, it's a big deal. And it's really big contrast to the jets screaming overhead. But yeah, here it comes. It's going to just go sit there in front of you and go off.
Okay.
Um,
Do people get used to it?
I haven't yet.
Okay. So people are staring at it when it's up there.
Yeah, for sure.
Okay.
For sure.
Is it notable to you that none of the other OEMs got one up in the air?
Listen, we own Joby because when we learned about these companies, we tried to understand who was ahead and who was
You want to own the leader in a new category.
for sure. And I think they're the best managed and with the product that's furthest along.
Okay.
And I think that evidence is that this is the company that has the product that's furthest along.
Okay.
I think Eve will be. There'll be other competitors, but who cares? Like it's a big world out there, and they're going to be behind Joby.
Let's touch on Archer then. Not the leader, but at one time people thought Archer could be a leader. I think the stock price has been. I own both. I own more of Joby because I agree with you, but I own some Archer because I thought the Midnight looked pretty cool.
It looks very cool.
Yeah. And that's the extent of my due diligence on that. But
its videos are very good also.
Okay.
And it has gotten off the ground.
Yeah.
So there's something
there's a
real
thing.
there.
There's a thing.
And there's resources behind it to get it to market. They have a balance sheet.
But that's a different model. They want to sell these.
Correct.
They're not looking, or they are looking to operate them as a taxi because they signed a deal with the city of Los Angeles.
Well,
they want to be the official Olympic eVTOL, which we'll see.
They will be the official Olympic eVTOL. There's no doubt
Will
about
they
it.
be ready? Will they be ready?
They gave the Olympics $30 or $50 million
Yeah.
for the right to be the official eVTOL. They will be the official eVTOL. Whether or not their aircraft is flying in 2028 is a very fair question. 2028. I think it's going to be a foot race for them to get it in the air.
Yeah.
But if they get it in the air, I think that Joby gets every bit as much advantage out of that as Archer does, because what people are going to find amazing is that these things exist and they operate.
Validates the category.
Right. And then, and then if they're actually, if you have actually airports and heliports in New York City where Joby operates them, the fact that people have seen the Archer one in LA and it's blown their mind, then, you're going to go use the one that exists.
Your firm is called ValueWorks. Traditionally, most people don't equate value with investing in flying cars. So I wanted to ask you to talk a little bit about how this fits in to the type of investing that you guys do. And like, how does your investment process work to the point where you buy Joby and you say, we're going to hold this for multiple years, despite the fact that there are no like traditional value metrics that make sense yet?
Well, I rebelled against the label value investor early in my career because I never
luckily for you, because it hasn't gone well.
Well, I did eventually turn around and settle on the name ValueWorks for my firm because initially, my sense of value meant you buy lousy businesses cheap.
Yeah.
And you simply apply your craft in the bottom half of the valuation continuum, trying to find something that isn't really terrible, but is priced really terribly. And, what I do is actually try to find things that are really exciting growth stories, but are trading at an attractive valuation. Our tagline is quality assets, compelling valuations.
Quality assets, compelling valuations.
Okay. Right. And how you determine valuation is always a little bit, specific to a company. Why did I think Joby was attractively priced when we stepped into it? Well, they had 2/3 of the share price in cash, and they had invested that amount again in building their product up to the point they had done it. So I was getting in at a very significant discount to what they had already invested in building this thing.
Mm.
And I think that eventually building this thing will be a money-making proposition. So we're sort of doing the same thing in Rivian today. They've invested $30-40 billion in getting their business to where it is right now. And I say invested, some of that's operating losses, but it's still money that had to be spent to get here. And if getting here is a good thing, then being at a discount to what was spent to get here is probably cheap.
I'm seeing the Rivians on the road. There were probably 20 of these EV manufacturers that came along 5 years ago. Most of them are gone. But the Rivian sort of caught on. It worked.
It worked. They're selling 50-ish thousand a year at the high end. I drive one. I think it's a good car.
Yeah.
And I think that, the barriers to entry to the next guys are going to be pretty harsh because there have been a couple that have gone broke. And the value of those cars has evaporated.
Of course.
And, if you own a car and the manufacturer goes out of business.
Not great.
Especially if they've only built 20, 30,000 over their lifetimes, right?
Right.
I mean, if Tesla would go bankrupt tomorrow, someone would figure out how to service your Tesla.
Right.
Right? If that company wasn't there's so many of them on the road, someone would service it.
Right.
When it comes to any other EV maker, if they're out of business, your car is worth a paperweight money.
So listening to you talk about Carvana and Rivian and Joby, I wouldn't use the term like broken growth stocks, but maybe the right way to think about it is companies that have made big infrastructure investments in their own future, but then other investors have given up. And that's when you get interested in taking a look. Because, hey, look, they already spent the capital. They already built the thing.
And the thing is there today.
The thing
thing is working. It may not be working as well as you thought.
It's a really interesting strategy because most growth investors, when everyone else gives up, they give up too.
Oh, right.
Okay.
And sometimes you're right to give up because sometimes the business is a fail.
Decision. Okay.
But if the business is not really a fail and they're just out of favor at this moment and they've just had hiccups, look, we own Instacart also, which I think fits right in that model.
Yeah, perfect.
Right.
Okay.
I mean, I think they're a leader. I think they've built their business. I think it cash flows nicely. And I think people have moved on because of whatever number of reasons.
Okay.
Including DoorDash being a tough competitor.
So you think 2026 will be transformational for the eVTOL space because finally there will be a commercial service, even if it's just a handful of these around the world. There will finally be a cash flow attached to each vehicle They'll lose money, but so what? It'll represent the start of people exchanging money to ride in them. And that's like a major turning point.
And the growth opportunity is pretty darn massive because...
How big do you think that this space could be?
You know, they're going to be doing tens of billions of dollars worth of sales 7 to 10 years from now. It's going to be a big deal.
Is that the reason to get in now? Is the chance that it works, is the reward is great enough to justify the risk of it not working today?
Absolutely. And to fine tune it too much, you know, this price is right and that price is wrong, could be a very big mistake.
Is there a hurdle for you to add other names besides Joby? Like, what's the deciding factor? Is it more about your own portfolio and not wanting to have too much exposure to the space?
No, wouldn't mind having another name in the portfolio. The valuations haven't been there for us. We looked at Blade long and hard as a business, and you know, the valuation never made sense. We never made the same value argument. We don't make the same value argument with Archer. We don't make the same value argument with Eve. You know, we don't make the same value argument with Lucid. I think Lucid is, you know, one of the ones that might not work.
Yeah.
But we would, you know, we have our eyes out for other ideas. You know, we walked the Dubai Air Show and kicked tires at a whole bunch of different places. And it wasn't just because we wanted to be sure we were right about ours.
Yeah.
It was because we were looking for other ideas.
Of all the holdings in your portfolio, what do the ValueWorks investors get the most excited to hear about? Is it this?
A lot of people like Rivian an awful lot. A lot of people like Instacart a lot. They don't love Spirit Aerosystems, but you know, they're being bought by Boeing, and we're getting at Boeing really cheap when we buy that. Nobody likes office property investors. That's a debt instrument we own on office properties.
Yeah,
and it's being a bit bumpy right now.
Right. But do you use that as a signal, like in terms of like maybe people are too excited about this and too pessimistic about that? Or do you try to tune that out and just focus on the value?
You know, I think you make a mistake when you put too much emphasis on whether there's enthusiasm for it today or not. You know, you don't want to focus on like, oh, I'm buying it at the high and that's bad, or I'm buying it at the high and that's good. You want to focus on, I'm buying it at this price and the stuff behind it is worth this amount. And that's either more or less, and the stuff is either going up in value or going down in value, and stay with that. And you know, look, yesterday's price is not a good indicator of tomorrow's price.
Well, fair point. I think we could leave it there. Charles Lemonides of ValueWorks. Is ValueWorks.com, or where can we go to learn more?
ValueWorksLLC.com.
ValueWorksLLC.com. Charles, thank you so much for coming. We'll keep in touch with you on Joby, and hopefully we'll have you back.
Thank you very much. Total pleasure.
All right, guys, thank you so much for listening. Thank you for watching. Smash that like button, and we'll talk to you soon.
We think ETH can be 7,000, 9,000 by the end of January, and that's a huge recovery move, but that's also pretty typical of what could happen in the fourth quarter.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at Wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next.
Ladies and gentlemen, welcome back to Wealthion. My name is Chris Perkins. I'm the president of CoinFund, and today it's my honor to speak with Tom Lee, founder of Fundstrat and chairman of Bitmine Inversion Technologies. The largest ETH treasury in the world, Bitmine now owns 3% of ETH token supply. And Tom, that's 2/3 of the way to your 5% targeted goal, isn't it?
Yes, that's right. Our initial target, and not necessarily our long-term target, is to get 5% of the circulating supply of Ethereum.
Amazing. So I just saw you down at the Cantor conference, and you've had one heck of a presentation. You talked about how the Genius Act and even the SEC's Project Crypto is going to be as transformational to the financial services, and you made it. You drew similarities to Bretton Woods and the U.S. dollar leaving the gold standard, and you said that this is going to be as big a catalyst. Can you unpack that a little bit when it comes to ETH and stablecoins?
Yes, I'd be glad to. For the listeners, in 1971 was when the U.S. formally withdrew from the gold standard, meaning the dollar was no longer redeemable for gold. And from that point forward, the U.S. and other countries, not every country went off the gold standard, basically said that from this point forward, a dollar is only exchangeable for another dollar. Okay, so the dollar became essentially synthetic relative to gold. And in 1971, many investors correctly bought gold because they said, well, that's the original store value. However, the second reality is that we had to suddenly protect the dollar to make sure it was going to be the world's reserve currency, because if that was no longer exchangeable for gold, then a country that was still in the gold standard could become the new reserve currency. So what happened? Wall Street built a bunch of new products to make sure that the dollar became the accepted standard. And over that ensuing 10-year period, it was money market funds were created, CDs, futures, ETFs, and it was successful because the dollar remained the global reserve currency. And today, it's now 80% of all financial trading pairs. In 2025, there is a similar evolution taking place, and it really started with stablecoins, which is that the dollar, which was already now synthetic, became tokenized on the blockchain. So now the dollar is now digitally represented, and that's what a stablecoin is, because it's backed by treasuries, but it's still basically just a digital dollar. That is going to be creating the roadmap for a lot of other assets to become digital, tokenized on a blockchain. And it's a big deal. We know that in crypto, for instance, the projects that have actually emerged from as native blockchain products have actually been better mousetraps. And that's something that is driving and sending Wall Street to build. The first of these has been the stablecoin in Tether. And Tether, as an entity now, it's valued, and they're raising at what is reported to be $500 billion. That would make it the second most valuable bank in the world. And even if it ends up being raising at 400 billion or 300, whatever that number is, they're still the second most valuable bank in the world after JP Morgan, which is 869 billion. So a company that has today maybe 300 full-time equivalent employees is almost as valuable as a bank like JP Morgan has 313,000 employees. So there's a lot happening. There's a lot of benefits that come from tokenization, and I think that that's the big unlock that's coming.
Yeah, totally. We're a fiduciary, and I know you're close with my partner Seth. We talk about this all the time. As fiduciaries, I think the equity markets globally have about 127 trillion in market cap. I think fixed income is about 150 trillion. But as a fiduciary, given the option and if liquidity was the same, I always have to buy the token rather than the legacy fiat instrument, because I can manage my risk on weekends and nights. And so I've always been of the opinion, slow, then all at once, everything has to tokenize because I need to trade it. Do you agree with that thesis? Do you think that's how it's going to play out? And what does that mean? There's plenty of blockchains. Obviously you are drawn to Ethereum. Would like to start getting into that as well.
Yeah, I agree with you, Chris. It is when something becomes native digital, it works really well. There's many examples. For instance, crypto trading 24/7 is an example, but look at how we do all communications. It is all native digital now. Emails are digital, or messaging. And in fact, over the last 10 years, I think it's a low estimate to say that at least 50% of all GDP growth in the last 10 years is native digital. It's probably now close to 60%. In the next 10 years, it's probably going to be 70%. So increasingly, almost all innovation and growth is native digital. And yet we're using geographically defined currencies, and we're trading instruments only 5 days a week with specific market hours, even though during those market hours, 99% of all the trading is already electronic anyways. I think one of the challenges as we tokenize is, of course, going to be making sure there's still the same liquidity that's available, because we know one of the glitches in crypto is liquidity is not universal. And so we do want to make sure prices are correctly reflecting a deep and full market whenever we see a price posted. But that's, of course, software. I mean, someone can define prices correct or put limits on price change if necessary.
100%. I remember back in futures markets where I come from, Bunds electronified overnight and liquidity migrated, over to Eurex. And so I think that phenomenon is definitely going to happen once again in our space. All right, so let's talk about Ethereum. You've talked about Ethereum entering a super cycle. You talk about stablecoins, as we mentioned, being that Chat GPT moment. You've made a 60K call on ETH. But right now, the market seems to be thinking about things differently. We've seen it pull back, ETH pull back under 3K. Personally, I think it's a great entry point. Why do you think this disconnect for something that is so obvious to you, pretty obvious to me? Why are we trading as we're trading right now with Ethereum?
Yeah. Well, Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're going to be reflecting investors' perceptions, because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. Whenever when you have something that has a hyper growth on ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800, I mean, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors. And that's why there's hyper volatility. It's one reason why BitMine ended up engaging Tom DeMark as a strategic advisor, because he is the king of sort of price discovery. He is the father of systematic timing. And in our conversations, when he looks at Ethereum, he sees what looks like engineered or systematic liquidation taking place. So there is someone that is in crypto, we know it's market makers play a big role, but there is someone that is probably capital constrained and is therefore bleeding or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level, because then that is creating what he calls a buy setup. A bottom in prices for him is when the last seller has sold, so that a stock or crypto no longer falls on bad news. I mean, that's what he thinks makes a bottom. So it would, I think, be a better situation to see crypto prices bleed lower to 2,500. But it could reverse at any time, because markets don't have to do what ends up being an ideal scenario.
Yeah, so I think you've talked about this, and we've identified it. There was a terrible market crash in crypto, and 1010 as we call it. Some crappy pricing, issues with feeds, a couple of other reasons, low liquidity. It led to this material auto deleveraging, as we call it, which I think some market makers, market neutral players were definitely caught off sides. And so I think what you're describing is this systematic selling. Is it all related really to that idiosyncratic event of 1010?
I mean, I'd say if someone wanted to say, why did crypto diverge from equities?
Yeah.
That's, I think, a big role, because they're in the past 6 weeks, nothing has actually fundamentally explained why crypto should be underperforming risk assets. Because the S&P, of course, has had a drawdown, but the S&P continued to rise for another 20 days. The S&P didn't peak till the 29th. So that divergence has to reflect either a change in how market function in crypto, or was there an existential new risk? I mean, the only new existential risk would be like if quantum innovations came along, but there hasn't been that. So,
you think it's existential or just idiosyncratic? I mean, nothing seems existential here to me.
Well, I mean, Chris, the one thing that I would say that maybe isn't reflected in price is the number of account holders that got wiped out on October 10th. And I think and we may not even hear from them because, they've been liquidated. I think to me, that's probably, now that could be someone's simply saying there was just too much leverage. That's why leverage is hitting crypto harder. I mean, that's a possible explanation. But to me, again, especially working with DeMark team, I think that there is something that is causing a lot continued leaking, but we're close to the end of that leaking.
Yeah. My sense is that we're going through a flippening right now. It's not the traditional flippening of ETH market cap surpassing Bitcoin. It's, to your point, it's the retail got hit. Retail ebbs and flows. Retail's ebbing right now. But the real flippening is that institutions are coming back into the market. And I think Bitmine and others are going to be a big part of making that happen. And so, I personally think you have this kind of this gap period, but I guess we shall see. Wanted to get back into your Ethereum core thesis, and as you're going around now talking to investors around the world, Bitcoin has been pretty easy to explain. It's digital gold. One of the things you spoke about was that 10 years. And to me, that's the starting line. When I was in traditional markets, I would need 10 years of risk before I could get into anything. How do you tell the Ethereum story, and how has it evolved, as you started to have these conversations?
Yeah. Well, I think you're spot on, Chris. Like when someone says, what is Bitcoin? I think everyone really accepts it as it's a store of value, a really good way to store value. And that's accepted today. In fact, someone might say that's like a Lindy effect, that people believe that. When we first started writing about Bitcoin in 2017, and digital gold was one way to sort of argue Bitcoin's value, it was not accepted because many people said, well, come on, I mean, it's just code. I mean, how can code store value? Or why can't there be 100 Bitcoins? Or look, I could create a new Bitcoin tomorrow, or I could fork Bitcoin and create a new Bitcoin, or I remember one client saying they couldn't buy a bottle of water with Bitcoin, so how could it even be valuable? So, but of course, all those arguments fell away. And now we have digital gold, Bitcoin, store of value. Even as gold gets tokenized, which I think will compete with Bitcoin to an extent, you still have Bitcoin, which is a really good way to store and transfer value. But Wall Street is also understanding there are a lot of virtues to a blockchain. And it's the ability to not only store value, but to store information and to actually transact and conduct and actually re-architect almost everything that Wall Street does, but they need a smart contract platform. And so that's where all these other L1s start to become a lot more important to Wall Street's future. Because if the big banks, the blue chips, build stable coins and they're going to tokenize stocks and let stocks trade 24/7, and then innovate that too, which I discussed at the Cantor, which is like things like factorize a stock. So just like in the bond market where you can factor a bond, we can factor Tesla so that you're only buying the implied future value of Optimus Prime. So instead of asking Tesla to make itself a tracking stock, you can synthetically create that on the blockchain. So you can't really do that on Bitcoin. So you have to build it on a smart contract, L1 or L2. And the reason I think Ethereum is going to be one of the leading platforms is, number one, its sheer size. You know, it is by far much bigger than the number 2 or number 3 L1s. It has a huge and growing developer community that is really dedicated, and it's global. So I think it's a true, robust community with actual known values, and it's a neutral blockchain with 100% uptime. So I think that this becomes one place where it's going to be easier for people to create innovative products. So for instance, let's say JP Morgan or Goldman want to just do tokenized stocks in 24/7, and they want to control as much of that as they want, as they can on a blockchain, because you lose a bit of control. They may not necessarily say they want to do a lot of this on Ethereum, but then someone's going to come along and create a product that does do this, and it's supported by a community, and then it gathers all the liquidity. That's exactly what happened with something like Polymarket, right? On a prediction market basis, where it came natively out of the blockchain and today broke out into the real world and is, look, it's the most cited way to actually understand events in the future. I mean, it's the Polymarket is the closest to having a crystal ball today. Like, it is the closest to tomorrow's newspaper, and it's a native blockchain product. It didn't come out of an existing Wall Street desk that created this product. It was created by builders. So that's why I think Ethereum, and it doesn't have to be only Ethereum succeeding. You know, I think Ethereum, there will be room for others, but I can see the clearest roadmap for Ethereum succeeding.
Yeah, on Polymarket, man, I've been watching it like crazy. It's just such good information to have, and I think a lot of bullishness is going to happen with Mike Selig now as future chairman of the CFTC, being able to normalize those markets. On the bank side, I don't think a lot of people saw this, but I'm an ex-banker. Basel really drives bank behavior. And the fact that even Basel's now saying, I think we got it wrong with the stablecoin thing. We're actually going to make these capital rules more favorable. We have to rethink them for public blockchains like Ethereum. I think that's going to be a humongous unlock. Anyway, wanted to get to the DAT story. And, you know, I've been a big proponent of DATs. I think that they're going to be a really important interface for these ecosystems, being able to access public equity markets. But there are a lot of haters out there. They don't see the value. You are chairman of the second largest DAT in the world, the largest in Ethereum. How do you address those haters? What's the value that DATs bring?
Yeah, Chris, I think DATs are becoming an asset class, but the market is skeptical, as you said. The reason they're skeptical is that there are so many DATs that it's not clear what differentiates each strategy of a DAT. So I think maybe to level set, I could explain MicroStrategy and Bitmine, and they're pursuing different strategies. MicroStrategy has 3% of the Bitcoin network. They've become so important that I do think that they have what I call a sovereign put. We know sovereign funds are buying a lot of Bitcoin. They continue to buy it. So as much as Bitcoin has languished, it's really, as you know, shifted hands to basically large holders now. And MicroStrategy owns so much Bitcoin that if the U.S. government ever needed to buy 10% or whatever size of the Bitcoin reserve they want, MicroStrategy represents a very easy way to get 3% of that. So I think that they have endurance that way. And then they've been very clever about essentially productizing their balance sheet and monetizing Bitcoin's volatility and its future price appreciation with all their various products. Now, BitMine also owns 3% of Ethereum. So we are similarly scaled to MicroStrategy, but pursuing a very different strategy at the moment, which is BitMine knows that there is infinite future innovation in front of Ethereum, because Ethereum and the Ethereum Foundation have really shifted to becoming a lot more friendly to financial innovation and products. Even Vitalik thinks that's, because he's pro-user. But Ethereum needs bridges between Wall Street and the developer community and the DeFi community, and really defining parameters and identifying projects and prioritizations and even alliances. And that's where BitMine, with 3% of the Ethereum network, is essentially, in a way, becoming part of that bridge. We are really trying to align ourselves very closely with the Ethereum Foundation and a lot of developers, but also acting as that conduit and idea generator for Wall Street. So that's how we're trying to accomplish this as a DApp. But of course, you should stay tuned, because that means by necessity, we're going to have to also spawn and create additional businesses to support all those functions. And I think that's why BitMine and MicroStrategy have a clearly defined idea that there's a power law at play. And then as you start to become more reflexive with the community itself, you're going to be creating other opportunities and productizations. Of course, we don't really reveal things that we do before we do them.
Yeah, for sure.
So that's, and then I think the other DATs have to really also then ask themselves, are they scale players on their own? The good news is that within Solana and Ethereum, because of the native yield, the companies the DATs that have raised enough Ethereum can probably have viability if they're not going to grow their ETH holdings.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com.
Yeah, so on that, you just announced the Made in America Validator Network, which is good. It seems like it's going to be core to your operating company. Is that going to be one of your core businesses?
It remains to be seen. I think, but it's an example of how BitMine operates, because we were looking at staking solutions, and we sent out RFPs to almost every major staking provider. We did comprehensive audit and review, and we selected 4 really initial partners. We haven't named them yet, but then these 4 are going to help us actually create the Maven staking network. And it's because we want to have a best-in-class solution, but it's also OFAC friendly, U.S. Treasury friendly, Wall Street friendly. But it's an example of how we're trying to create standards that are really we're not trying to optimize for like time to market, right? We're pretty slow to announce a staking solution.
Yeah.
But we wanted to be really thoughtful about it. And of course, we also wanted to make sure we weren't going to have a negative impact on on actual staking itself.
Yeah.
Because, with 3.6 million Ethereum, it's a huge amount of ETH to move.
Yeah, 100%. But that should drive some nice sustainable yield, probably around 3%. You also made a strategic investment in Orbs, or 8Co, which is the WorldCoin DAT. I think it was like a $38 million stake. Can you explain how that ties into your overall thesis?
Yes. And BitMine made a $20 million investment in Orbs, but in 8Co, which is the ticker Orbs.
Yeah.
But WorldCoin, I think, is actually one of the really most unique projects out there. Now, for those who aren't familiar with what World does, World is offers proof of human verification. Okay, and the way they do it involves a lot of proprietary technology that really works. They are essentially scanning someone's iris, not storing your iris. They're not storing your biometric information. So you don't have to worry about, Big Brother or surveillance on chain, because they're doing a cryptographic hash of your iris. So all they're doing is uniquely recording that you have an iris that no one else has. And that's really important because we know that in this world that's becoming increasingly digital, it's harder to verify our own humanity, but also verify that it is us. Whether it's voice or deep fakes, and especially in an increasingly agentic world where there's going to be autonomous agents and even robots, I think it's going to be important. So World is one of the few real solutions out there. And so the token, of course, is the token of the World technology. And so and it's an ERC20, it runs on Ethereum. So to us, that's a really important project, something that we want to support. And the way we can support that, of course, is to invest in a treasury, a WorldCoin treasury, which is the ticker Orbs.
Love it. Yeah, big fans of that project as well. Tom, so you have Maven. You're doing strategic investments, and it sounds like you've got plans that you can't really talk about. You also announced recently a dividend. Can you talk us through that calculus?
Yeah, glad to. We announced an annual dividend, and it's an operating dividend of $0.01 per share. Now, it reflects BitMine's commitment to focus on shareholder return, and this is a dividend. It's going to represent a payout that's less than 1% of expected earnings. So, of course, it's sustainable. It doesn't require borrowing any money to pay the dividend, but it also is unique because if we look at the world of large cap crypto stocks, we are the only company that's over $9 billion of market cap, or even $5 billion, that's paying a dividend. In the future institutional world, paying a dividend is not only a sign of stability. NVIDIA pays a dividend. In fact, roughly half of the Mag 7 AI stocks pay a dividend. But it does allow you to also be owned by core funds and income-oriented funds as well.
Love it. And the other differentiation I would suggest is just your sheer volume. Today, BitMine's the 50th most traded stock in the U.S. I think it's trading 1.6 billion per day. That seems like, as you're moving into the institutional space, something that's very important. Can you unpack that?
Yeah, and BitMine really does benefit from a stock that trades really actively. Even this morning, we're trading about the same volume as, basically as Palo Alto Networks. I'm just taking a look at it now. So we trade like a large cap tech stock, and we also have really high volatility. The implied volatility of Ethereum is already quite high. It's more than twice that of Bitcoin, but the implied volatility of BitMine is super high. So it attracts a whole class of not only individual investors, but it does attract a lot of high frequency traders because volatility and using our options chain makes it very attractive. And there have even been leveraged ETFs created. I think there's 2 leveraged ETFs created for BitMine. And at some point, it is attractive to actually try to monetize that volatility. MicroStrategy did that by doing a series of huge convertible offerings. It ended up, being a meaningful percentage of how they raise capital. So it's a future option for BitMine, but for now, we would prefer to keep the company's balance sheet super clean. Again, a company is just straight equity funded.
Yeah. So I wanted to get into MNAVs really quick. And right now, the entire DAT space is pretty much, most DATs have an MNAV below 1, meaning that the price, the market capitalization of the stock is less than the value of the underlying crypto. It kind of puts DATs in a difficult position because it's not a great time to issue new equity to buy tokens. How do you navigate this situation where the MNAV drops less than 1?
Yeah. Well, if a company has their MNAV below 1, they do have a few options, but it is a lot of it is essentially a situation that is not always entirely in the hands of a company, because when something trades below 1 MNAV, it reflects pessimism about the future, an element of the future of that company. For instance, it could be trading at a discount to MNAV because the company has an expense structure that's too high.
Yep.
So I think there are several DATs where their asset management fees are really high. A really well structured DAT should have an asset that custody and management fee should be below that of an ETF.
Yep.
And ETFs are 44 basis points, so that's like what your fee should target. The second is that's the market could be very skeptical of the prospects of that crypto itself, because a stock is a discount to the future, and then a crypto token is a discount to the future. So the stock, in theory, is going to be signaling price expectations about the crypto, maybe even before the crypto does. In fact, that's why if someone's trying to figure out when Bitcoin bottoms, they're actually better off watching MicroStrategy. Mm-hmm. MicroStrategy turned down first before Bitcoin rolled over, and MicroStrategy stock will bottom before Bitcoin bottoms. So if a company is in the position of trading below NAV and they're viable, so let's say they have enough ETH and they actually generate yield, they know that they aren't going out of business, so they don't need to raise money. But they also can't necessarily raise money using equity. Okay, so if that DAT wants to grow, they have to do a non-equity instrument to grow. So that's one solution. If they want their equity price to recover, then they have to convince the market of 2 things, or 3 things really, or all 3, one of 3 or all 3. One is they have to convince the market that they are a viable steward of capital. And if their expense structure is too high, they have to right-size their expenses. Then they have to, secondly, convince markets that they are shareholder friendly. And that either means, a roadmap to what they're actually doing, and it shouldn't be maximizing staking yield, because I think that makes investors nervous, because there's no such thing as a free lunch.
Yeah.
But it could be a shareholder return plan. But if they are a small company and they're not growing, that is a really tricky spot to be in. Like if you're sub $1 billion, that's a wasteland in the equity world, as you know, Chris. Like you come from traditional markets, like sub $1 billion, like there's a gajillion companies.
Yeah.
You need to be closer to 10 billion. So the third is that they have to take action, and either they can try to consolidate with each other to get bigger.
Yeah.
They can convert to an ETF. So become an investment company and then convert to an ETF, and suddenly they won't trade at a discount. They could start dividending all their yield, and if they're right sized on expenses, that works too. But a proper DAT like MicroStrategy and BitMine, they're not trying to just be stable with their holdings. They're trying to grow accretively their crypto holdings per share. even MicroStrategy has managed to raise a couple $2 billion in the past month.
Yeah, I think the debts that are well managed and expect for these days to come. I mean, we've been in finance forever. You always end up in the tail. Something always happens, and you need to be prepared. So the folks who can weather this storm, I think, are going to be really well positioned. So how long do you think, Tom, until M&A really hits this space? I mean, it seems as though those companies you're talking about that didn't quite make it, it's going to be M&A season here in the DAT space. You think that's on the horizon?
Yeah, it has to be, Chris. So, the DATs, the fact that there's a lot of DATs flailing doesn't surprise me because that's capitalism. Today there's only 3,000 listed stocks. But 3,500, right? Or I don't know, 42. I mean, Wilshire 5,000 is no longer 5,000 stocks. Yep. But there's been like more than 45,000 IPOs and spinoffs since 1970. In fact, that stat I'm citing ended at 2015. So there's probably close to 55,000. And in our study that we did at Fundstrat, 90% of IPOs and spinoffs fell 90%. And of those, half of them went to zero. So meaning most companies fail. And so what we're seeing in DAT world, just like in crypto, is that this Darwinian process is happening very quickly. But in order for mergers to happen, it's the seller has to become realistic. That's, I think, the problem. Because a seller would say, well, in June, I was just at this price. Why do I have to sell now? So I think that's the sobering of that process is probably what's holding up M&A. Because of course, there's plenty of buyers out there. But, one of the tricky things is, someone who's trading at a premium to NAV is not going to want to pay a premium to NAV of another company.
Yeah, 100%.
Trading at 0.7 because that's offering a massive premium. So it's really just the bid ask is probably the biggest impediment.
We have the Fed coming up. It looks like they're now going to cut after they weren't sure. Now it looks like they're going to cut. I'm tracking Polymarket, but how do you see this macro setup? It looks like sentiment is terrible right now in the space. Macro seems to be kind of getting better when it comes to the rates outlook. I would say medium to long term between regulatory de-risking. It's actually a really good setup for DATs, particularly where the MNAVs are right now. It's really my last question here is how do you see macro impacting you in the space?
Macro is actually really a big deal, Chris. Crypto was the first really to sniff out and it's going to be responding to a Fed, right? And if the Fed's remains hawkish and executes policy error, that's bad for crypto prices. That's why it's really important for anyone involved in crypto understand that what the Fed's going to do is a big deal. I think the Fed is in a very difficult spot because if there wasn't what looks to be as political interference, I think the Fed would be cutting without question now because bond market is showing future inflation expectations are falling, and that means that if monetary policy doesn't adjust, its real rates are getting tighter. We're actually putting more tightening into the economy. But as you know, the Fed has to make sure its actions don't look like they've been politically driven.
Yeah.
And that not just the market's perception, right? Because people tend to think of it as, oh, well, this is the bond market or stock market's conclusion. That's not really what I think that what the Fed's concerned about. It's really the integrity of the organization. They have 30,000 or more employees, and each of them is seeing this relentless attack from the White House. So I think to the extent that the Fed governors and the voting members know that it's the morale of the institution that's at stake. So this is why the Fed is even more guarded in their actions and much more deliberate in their messaging because they don't want anything they do to look politically motivated. And unfortunately, that's been bad for markets because the markets have interpreted that as the Fed is is hawkish, and I mean they do sound hawkish. So I think it means that there's going to be an alignment later months when inflation is fallen enough, and the Fed can now make cuts where it's no longer viewed as politically motivated.
Right. So you need a little more overhead cover. Awesome. Really appreciate it. Any last thoughts, Tom, before we let you go and get back after it?
Well, it's just I think for anyone who's involved in crypto for a long time knows this, and so there's many who are new, but crypto has declines, and we're not necessarily in a bear market, and it feels terrible. In fact, that's what you have to be mindful of, is that it's a hyper volatile space. So it feels terrible now, but just like in 2024, crypto felt terrible for many months, and then we've had these big moves.
Yeah, you have the meltdown, then you have the melt up. Volatility works in both directions. Before I let you go, any price targets for ETH?
Yeah, I think, well, in the near term, there is downside, maybe to 2,500, but that's minor compared to the upside of trying to discount a super cycle. So we think ETH can be 7,000, 9,000 by the end of January, and that's a huge recovery move, but that's also pretty typical of what could happen in the fourth quarter.
I hope you're right, sir. That would be music to my ears. Really, really appreciate you coming on, and I learned a ton today. Ladies and gentlemen, Tom Lee, founder of Fundstrat and the chairman of BitMine. Thanks again, Tom.
Thanks, Chris.
Really appreciate it.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at Wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next. Thank you all for watching. We'll see you again next time.
Okay, we are here in Washington, D.C., in front of the White House, having spent the afternoon with our friend David Sachs, our friend Elon Musk, and others. We are here to learn about the debt, the deficit, what's going on in D.C., and we have an incredible interview lined up with Scott Bessent, Treasury Secretary of the United States.
It was amazing.
And it's been an amazing afternoon, and we're really looking forward to it.
It was amazing.
Well, this is the intro to the video.
It will be amazing. It's not the pre. Let's just. This will be.
What the?
We're going to pretend it's the pre.
It will be incredible.
It was incredible.
But how cool is the White House? And here's a bell.
Okay.
I'm pretty sure the bell.
I cannot even describe to you the day we had running around. It's incredible.
Running around room to room in the White House.
One of the best days of my life.
It was one of the best days of my life. It was incredible.
Incredible.
I think this bell is probably pretty important. Can you guys get a shot of this bell?
Also, I
don't know what it is, but it's really important. Yeah.
The White House to people, 201, super kind, super open, super curious. I mean, you felt it? You felt accepted?
Yeah, I felt it, but I got free soda. They have a soda machine where you can make any Coca-Cola flavor you want in the White House. It was pretty cool.
I took some hummus, I wrapped it on Freebird's face, and I punched him in the face.
It was a cool afternoon. And this is, what is this? The East Wing of the White House. And we took a walk from the West Wing all the way over to the East Wing.
Through the portico.
And then we snuck in. Well, we didn't sneak in. We walked in. And then we're walking around the East Wing. We went to all of the private rooms. I got great photos. We'll slice them into this video. And then some Secret Service dude comes up and he's like, what are you doing here? This is the residence of the president. You have to get the out. He's like, you need to go downstairs now. So we got kicked the fuck out. But it was an incredible tour.
Super great.
Yeah. Anyway, we're excited for this interview with Scott Bessent. Hope you enjoy it.
All right, besties. I think that was another epic discussion. People love the interviews. I could hear him talk for hours. Absolutely.
We crushed your questions. Admit it.
We are giving people ground truth data to underwrite your own opinion. What do you guys think? That was fun. That was great. Well, today's a really important day. We're joined by the 79th Secretary of the Treasury, Scott Bessent. And this is an opportunity that we wanted to take as part of a longer form way of explaining to people not just how the economy works, but in a little bit more detail, where are we in this moment in time? Where are we with deficits, tariffs, the budget? economic, monetary, fiscal policy? How do we make sure that we all understand the plan to make America great again? So, Scott, thank you for joining us.
Good.
Thanks for being
Gentlemen,
here.
thanks for having me.
Oh.
I actually want to start with, let's go back in the Wayback Machine. So, South Carolina, your father was a real estate developer. Tell us where the passion for finance came from.
I don't know where finance in particular came from. As you mentioned, my dad was a real estate developer, and he was kind of boom bust kind of guy. So I think that's where my passion for risk management came from. But I was very fortunate. Went to Yale, wasn't sure what I wanted to do. 1980, when I got there, probably you all can imagine this, but there used to be these things called punch cards, and we'd just gone, the Yale computer system had just gone from punch cards to screens. I was going to think of being a computer science major, maybe a journalist, because people actually used to read newspapers, so punch cards and newspapers from the Wayback Machine. And I got an internship just for an individual, and he taught me the investment business really well. And
who is that?
His name is Jim Rogers. He's famous. He was George Soros' first partner. He had just completed an around the world motorcycle trip and written a book called Investment Biker. And fascinating guy. And I did the investment business, and I thought, this is really what I like, because it's quantitative, so I had to use my quantitative skills, but you're also constructing a narrative, and it's also like human emotions.
And you were trading equities, bonds, everything, currencies?
Well, I started out with equities, and I did that for several years, and then I actually ended up at Soros Fund Management. I worked for a fellow who's my mentor, Stan Druckenmiller, who's incredible. I think he's more than 40 years now, never a down year. And when you're sitting next to him, I think, well, what am I doing all day?
And notorious for going all in several times in his career.
All in. And
only when he's right.
Yes, well, but he is the best at changing his mind of anyone I've ever seen.
So Druck has that famous adage, invest then investigate.
Well, he has several. And I'm trying to get him to write a book, because he has so many of these great things. Maybe you all could press him. But invest, investigate, it takes courage to be a pig. Right. So, and then I was hooked on markets, because again, it was everything. It was quantitative, it was qualitative, and it's real time. You get real time feedback all the time. And you could have a long-term view, but then you're trying to gauge the short term against that. And I loved it. And for 35 years, I've gotten to, I did what's called macro investing. So eventually I was trading currencies, bonds, commodities, the equities, some credit. And I got to travel around the world, meeting leaders and trying to figure out what the next move was in policy.
I think this is important because I've spoken with folks who trade in macro, and a big part of the role of being a macro investor, macro trader, is really knowing where central bank action is going to be, really knowing how government bonds are going to move, and spending time with economists, not just central, but around the world, and learning a little bit about how capital is flowing all over the world. Is that kind of the right way to describe that role of being a macro investor, just for folks? Yeah,
it's a lot of that. There's another great macro investor called Bruce Kovner, and he had this saying that he said, I succeeded because I could imagine a different future and believe it could happen. So the key is to believe it could happen and then manage the risks. So, could you imagine what would happen if the Iron Curtain came down? What would happen? I mean, you all do as venture capitalists, but how could the world live in a different state?
Okay, well, let's hold that idea and double click for us to 92. It's probably one of the most famous moments where the broader world at large met macro trading. And this was really where you and Druck and Soros basically broke the back of the Bank of England. And it's really an interesting window into assessing all of these things. So can you give us the conditions on the ground at that moment and what new reality you saw for England? And then it would be great from there, we'll contrast and compare it to America today.
Good. So it's a great historical example, and it also kind of brings in three dimensions. So I was the analyst, Stan was the portfolio manager, and then in a way, George was the risk manager.
Okay.
So I was running the UK office. I was on the ground in the UK, and I had this light bulb go off, and I thought kind of the fulcrum thought, or like my differentiated view was that the UK had just had a big housing boom. Mm-hmm. And UK mortgages at that time, they didn't have long-term mortgages. They were all floating rate. So if the Bank of England raised rates on a Wednesday, your mortgage went up on a Friday.
Yeah.
The UK had hooked into something called the exchange rate mechanism. They had to balance versus the Deutschmark. They had to stay within a band. I noticed that if they raised, or I thought if they raised rates to try to stay in the band and protect the currency, it would be unsustainable because British homeowners would get bankrupted. Stan's great feat of analysis was figuring out that, gosh, these bands set up this incredible asymmetric bet because I can push them up against one side of the band, and their mandate is just to push me back to the other side. Right. So we just lose 2.5%. And Stan tells this great story of like telling George Soros, oh, well, here's what I want to do. And he says he told him, and George says, well, how much do you want to do? And he said, probably 100% of the fund. And he said, Soros gave him this really sour look. And he thought that he had said something wrong. He goes, well, why wouldn't you do 3 times that? So anyway, it was, we pushed them against the band. The Bank of England, the British government had to buy this unlimited amount of pounds, and they started raising interest rates. And this was September of 1992. And eventually, they just weren't able to sustain the pressure from the high rates and came out. And then the asymmetric risk reward was we made about 20-something% in a day.
Yeah.
Right.
And back to what was really Stan's genius is, I don't know if either of you play backgammon, but in backgammon, there's the move after the move.
Yeah.
And so Stan, we'd made all that money and we were kind of euphoric. He goes, okay, now what? Because there's going to be the trade after the trade. So we made that much in a day, but then it was actually the trade after the trade. This isn't well publicized. I think we made another 20% during the rest of the year.
Wow.
Yeah.
So in that moment, what you're really observing is that the real economy is somewhat dislocated, maybe meaningfully dislocated from the financial economy in your operating. And I think you've said this now many times, and you've basically used the terminology, the Main Street, Wall Street dichotomy. How do you observe the moment in 2025, maybe what rhymes with the early 90s or other periods where you've been trading actively?
Well, look, I think it goes back to something that's unsustainable is unsustainable. And one of the reasons I'm sitting here now is about 18 months ago, I went to see President Trump. I'd known the Trump family for 30 years. I'd never known the president that well. But to tell him that I wanted to get involved in the campaign because I was so alarmed with what the Biden administration was doing with the debt and deficit.
Endless stimulus, endless spending.
Endless spending, but endless spending when we were in like solid economic territory or not in a war. First time ever. And I thought it was very cynical because I actually thought, well, we're going to spend, and then there'll be no choice but to raise taxes.
Right.
So you'd go into this equilibrium that you could just never get out of, and you become kind of a European-style social democracy, the malaise.
Yeah.
And I also think they were very cynical on immigration.
Right.
Because if you take kind of the stated number, 12 million, the president's number, 22 million, I don't know what the truth is, kind of lean toward the president, but it was, we're going to let all these people across the border. You can't ever make them, problem's too big to make them go home. But I like to stay in my finance lane. So the finance lane was, we're going to just go to the point of no return and kind of inflict the progressive financial values on the country. There'll be no way out.
You had very meaningful wage suppression in that period. And you had an equity market that was incredibly well bid just because the money supply was just always there.
Well, it was always there. And you had these distributional aspects, because back to your question, Wall Street versus Main Street, that it was driving me crazy when Vice President Harris said, I'm going to fight for the middle class, and she'd eviscerated the middle class.
Right.
Or these policies, inadvertent, intentional, had eviscerated the middle class and really the bottom 50%. So we're in this.
Because purchasing power goes down, inflation went up.
Well, if you didn't have assets.
Right.
So
that's really important. I think people don't understand this, that if you had stocks, if you had assets, your assets inflated.
Yep.
But if you didn't, the cost of everything inflated, but you didn't have the ability to purchase because your wages don't go up.
Yeah, and Dave, not only did inflation go up, but if you look, Jason Trinard has this thing, I think he calls it the Everyman Index.
Mm-hmm.
And so CPI went up about 22 during the period,
yeah.
but the Everyman Index was up over 30,
right.
35%, because the bottom 25%, the bottom 50% of wage earners have a different basket
100%.
than we do, and it inflated much faster.
100%.
Used car prices were
car
up.
Insurance.
Car insurance, rent, groceries,
yeah.
And like not only is it unfair, but it's just unstable.
Right.
And
creates civil issues.
Yeah.
Societal issues. But sorry, as you guys got into looking at this, I remember Stan talking about this in the summer of 23, I think it was, or 23, yeah. And what was the point of view on what should have been done at that point in time? And then how much farther did it go? How much longer did it last?
Well, I think what happened, the Democrats will tell you that the big spending bills were needed for rescue.
Yeah.
And I would say in March of 21, the economy didn't need rescue, it was already in recovery.
Right.
So these were rescue-sized packages, and even Larry Summers, I remember there was a great debate between Larry Summers and Paul Krugman, and Summers, I think, said, look, this is at least $900 billion, $1 trillion too much, and the Federal Reserve was summer of 22, Federal Reserve was very slow off the mark. And we ended up, and again, imagine top 10% has assets, stock market is flying, you're in the bottom 50%, you have no assets, but you have debt.
Yeah.
Yes.
So credit cards are up, mortgages, impossible to buy a house. House prices had gone through the roof due to COVID. So it really did end the American dream. But we've been suffering these distributional effects.
Scott, what is the American dream today, do you think?
Look, I think the American dream's what it's always been. But after World War II, I think 90% of American families, the children made more than the parents. Now I think it's 50-50.
Mm-hmm.
But it's to own a home. It's financial security. It's to some level of comfort. It's purpose in your work. It's to be able to support your family, to be able to have choices, to not have to work two jobs. I made a remark at the Economic Club of New York last week, 2 weeks ago, And Mike Pence decided he was going to troll me, and because I said the American dream is not built on cheap goods,
Right.
and he said, "Well, yes, it is." And I just say, look, Vice President Pence, this let them eat flat screens economic policy that isn't what people want. They don't want the baubles from China. It's like the old.
They want progression. People want progression. I mean, I remember reading. There's I think Jonathan Haidt had some work on this a long time ago, where happiness is measured by your change in net worth or income per year. It doesn't matter what your absolute levels are, by all these socio-economic kind of surveys that they do. That feeling like you're having some progression in life is what folks are looking for. And I wonder whether solving for that, we created a system. And I'd love your point out your read on this, that we said everyone should own a home. That's the American dream. And in order to do that, people put most of their net worth into a home. 60%, I think, of middle class net worth is tied up in a single asset. And then in order to get them to feel like they're progressing, we've created a system of loans and a system of kind of economic and fiscal policy that ultimately drives the value of the home up every year. And now we're kind of in an unsustainable housing bubble. Most people can't even afford to buy a home. What did we get wrong there, and how does that affect what the American dream should look like going forward?
Well, I think a lot of it's scarcity, because what you're talking about is like out in San Francisco, super tight zoning laws. So there's scarcity for homes. If you think like Ivy League education, all of a sudden you gave all these people access to Ivy League educations, you brought in international students, but the number of degrees awarded at Harvard, Yale, Princeton probably hasn't changed very much since the 1950s. So you created just this demand for scarce things, which leads to this anxiety.
Mm-hmm.
But you also created, I think, a sense of hopelessness through, because if you're,
can't access. I will never I will never be able to pay down student loan. I will never be able to afford a home. I can never see my income growing to give me access there.
Yeah, and
so is that a dereg solution? Is that the
Well, I think
intention?
the first part of it is it's a data problem, because in order for the government, I mean, the one thing that struck me about, I think, this Trump 2.0 administration is I think you have a better beat on the fact that this data is not as reliable as other administrations would say they were, in order to do whatever it is they wanted to do anyway. So it's sort of like, let me just find the data that justifies what my action is. And part of why you can't, I think, tell this story is, do you trust the GDP numbers? Do you trust non-farm payrolls? Do you think these are reliable enough for you to act on behalf of the United States?
No, look, they're subject to big revisions over time. And I thought one of the big mistakes the Biden administration made, and thank goodness they made it, was they refused to, they went with the numbers, not what the American people were feeling. They said, no, it's a vibe session, and you really don't understand how good you have it. You know, this has happened, this has happened. When in reality, I was on Meet the Press yesterday, and there was something that said, well, the American people don't believe Donald Trump's doing enough on the economy. And I told the host, I said, you know, the one thing I'm not going to answer is that they don't know what they're talking about. I have to have respect for how they feel, and then we need to go back and look at what is causing this anxiety. So that's what we're going to do.
So let's peel the onion back. What do you think is causing this anxiety? Where are the levers that maybe the federal government can control in releasing some of the pressure, and what are more market functions that just need to clear up some of these?
Well, look, I think we're trying to do three things, and I think you may have talked about it last week before.
Yeah, the three legs on the stool.
The three legs on the stool, and from the outside, you intuited that very well. I would do just a little refinement on that.
That's what I was going to ask you. Yeah, just tell me where I was right and wrong.
But you were adjacent to everything.
Okay.
So on one, we are trying to bring down this massive federal debt, cut the spending, but in a controlled way. because you can't do it all at once. I don't like to repeat private conversations with the president, but I'll repeat this one because I think it's it really illustrates where his head was at. First time I went to see him, saw him at Mar-a-Lago, and walked in the door. He said, "Scott, how are we going to get these debt and deficits down without causing a recession?"
Fantastic.
And
Great question.
that's exactly where we are now. How are we going to get the debt and deficits down, not cause a recession? And I said, "Sir, when you win, you didn't get us here. We're going to set a goal by 2028. We want to get back to the long-term average. We're going to deflate it slowly. And
long-term average being about 3% deficit to GDP.
About 3.5% deficit to GDP. And like I keep saying, the U.S., we don't have a revenue problem. We have a spending problem because we are averaging right about 18% revenue. And I'm talking about federal government, federal government only. We're at about 18%. And Biden administration blew the spending out to 25. Normally, it's about 21 and a half. We have the 2% inflation, nominal GDP, real GDP is 1.8, so we get nominal GDP 3.8, and it all works out.
Yeah.
And it was very interesting. I had one of the heads of one of the Singapore sovereign wealth funds here last week. Guess what Singapore spends in terms of spending to GDP?
Deficit 3%?
They have no deficit, but they spend 18%.
18%.
18%. And he said, we have a lot in common with the Trump administration. We like small government. We don't like immigration, illegal immigration, and we like personal safety, which I thought was very interesting.
Sorry, so let me just understand. So deflating government spending is key, but the big challenge has been that we have now accumulated 30 some odd trillion dollars nearly of debt, and the interest on that debt has started to grow. We now have to pay $1.2 trillion in interest payments per year. So that starts to consume more of the spending budget that we have at the federal level, which means we can spend less on the rest of the federal government's programs, meaning you have to cut a lot more than you otherwise would have, which is what makes it so difficult and so painful. Is it realistic that you can get Congress to act in the way that Congress needs to act to get to the level that we need to get to, given the high interest payments and the high debt level that we have?
Yeah, and with this Republican Congress, and I'm not sure what a deficit hawk is, but I think I would qualify as one. And a lot of the Republicans, I actually have to coax them. You can't do this all at once. I was with one of the congressional budget committees 2 weeks ago, and they really want to cut this fast. And I said, you do realize every $300 billion we cut is about 1% of GDP. So we are trying to land the plane well, and the plan, because that's really what I'd like to talk about today. I think there are 3 plans here, but plan 1, we're going to de-lever the government via the spending. We are also going to shed excess labor from the government. So on that side, and then on the other side, we're going to deregulate the financial system. The regulated financial system's really been in what I call a regulatory corset for a long time. And as we deregulate that, then the private sector can re-leverage. So government deleveraging, private sector re-leveraging, and the employment or the folks who lost their government jobs will be picked up by the private
more productive.
sector.
So this is really important, and I think this is the most critical thing. I'm really glad we got the chance to talk today, because I hear so much about the conversation on any one of these topics independent of the others, and there's a relationship between them that I think is critical to understand on how this administration is aiming to drive an economic recovery that is not inflationary, is sustainable, and also will allow people to have the American dream in a way that they can't have access to today.
Yeah, and so part of fixing the affordability crisis is what can, and we come back and talk about it if you want, but where can we get prices down? Like eggs are easy, but the other side of getting prices down is getting real wages up. Mm-hmm. So on getting real wages for working people up, it goes back to the Main Street versus Wall Street. And the second plan is to reorder the international trading system and bring manufacturing jobs back to the U.S. and reinvigorate the middle class. Because again,
through tariffs.
Well, to use tariffs, we're needed to bring other countries into line.
And to create an economic incentive to onshore for some industries and some supply chains?
Well, so there's tariffs. Then I think there are three other things we can do, which are the centerpiece of the administration. We can have the low and predictable taxes. We can substantially slash regulations, because regulations are the equivalent of
that'll drive investment dollars, private investment dollars.
And predictability in regulations, and then cheap energy.
Right. And sorry, what is the relationship between the tax cuts and the getting to 3%, 3.5% deficit as a percent of GDP?
Especially because the CR unfortunately gave folks a get out of jail free card because we kept the $2 trillion cap for an exit alone.
Yes, but you got to have. I've been in this building. I think this is my 7th week. President Trump been back at the White House for 8 weeks. So you actually do need time.
Yeah.
So there are a lot of people who weren't happy about the CR, but shutting down the government wouldn't have been productive, either politically or economically.
So sorry, does tax cuts get made up with tariffs, or does tax cuts get made up with cutting government spending?
Well, tax cuts and deregulation will change the growth trajectory.
Grow GDP.
Will grow GDP. If trend line has been 1.8, if you can move the growth to 3 or above,
right,
then you really change the trajectory. And if you can keep expenses flat or do the unthinkable and cut expenses, then you can really...
So this is important. So sorry, government revenue as a percent of GDP can go lower if you have lower expenses and a faster growing economy.
Yes.
I think that's like really important for folks to understand that relationship. And so in isolation, tax cuts might reduce revenue. But when done with reduced government spending and deregulation and a reordered international trade model, you theoretically will accelerate economic growth in this country, increase government revenue overall, even with a lower tax rate. That's kind of the theory.
Yeah,
right?
And I'll tell you, shame on me. I was in the investment business 35 years. I talk very confidently over that CBO scoring says this, and it turns out I didn't know what about CBO scoring. Like when you're on this side of the wall, you realize how crazy it is.
Right.
It's crazy.
It's quite a gameable system.
It's very gameable, and
quite
one of the most gameable parts of it is in normal CBO scoring. So we're saying that we want to renew the tax cuts.
Right.
We're actually just renewing the current tax regime.
Right.
But somehow, after they expire, then they go back to the old rate.
Yeah.
Spending never changes.
Right.
Like spending never has to get renewed.
Right.
And I think when I look and think about a mental model and how do systems work, how do they break down, one of the things that has caused this spending bulge is this idea that you never had to rescore spending.
Oh, it's nuts. And the incentive model is when you have a constituency that you represent as an elected representative that's earning from that spending, they're telling you, if you want to get reelected, make sure my earnings stay and get me more. And then every year you've got a set of elected representatives whose primary objective in a democratic system is to go in and get more money for their constituents. How do we solve that fundamental problem? How do you think about that?
Well,
when you got to deal with Congress.
Hold on a second.
Yeah.
Do you actually think that that's true? Do you think that most politicians are here to just get money for
That's a
their...
good question, yeah.
Yeah, I mean it's OPM, it's other people's money, but they.
Danny DeVito had that movie.
But you would regard that as being a good politician,
Right.
Like you brought home the bacon for your
That's right.
district.
Yeah.
Because the CR, a lot of people didn't like it, but one of the things that a lot of people didn't like, there were no earmarks in it. Like, how dare they?
Totally.
The Christmas tree bill that kind of shows up at the 11th hour.
Where everyone gets a little bit.
Yeah. Can you talk about, so we talked about this deregulation as this one very important lever, right? So how do we add 50, 100 basis points of growth back in? We're going to do it through deregulation. How do you undo the financial corset, as you said? What are the sort of 3 or 4 big ideas that you'd like to affect?
Yep. So we are re-examining all the bank regulations, and why are they there? Why do banks have to? I can't remember. It's 5 or 7% to hold treasury bills. What are the regulations? Why do I had a whole group of community bankers or small banks here last week, and why do they have to hold the same amount of capital that JP Morgan and Wells Fargo and Citi hold when they don't have the complexity, they don't have, why do the regulators, one of these small bankers said, well, Bank of America does it this way. Well, Bank of America has $1 trillion in deposits.
Yeah.
This was a $183 million bank.
Yeah.
Well, when you look at the regulatory overhang of some of these things, Basel I, Basel II, you have all of these frameworks. And then as a result, all these organizations that are running around trying to help you administer this complexity, all it does is just lower economic activity in the end.
Well, but I know you all talk about incentives a lot. Back to incentives, what's a regulator's incentive? Just to keep tightening the corset.
Yeah.
They don't care about growth.
Yeah.
They don't care about the common sense.
Turn off every risk is their job.
If you had to create a metric then to say, okay, here's how we're going to measure this undoing of the financial corset, is it sort of the lending velocity by private lenders so that the private re-leveraging can occur? Is that a good way to think about that?
Or is rates a way to think about it?
Well, it doesn't have to be rates, but if we do all the things I was just talking about, if we deregulate, if we have cheap energy, if we shed excess labor from the government, if we get government spending down, then inflation should come down, rates should come down.
Yeah.
But on the question of how are we going to measure it, I don't have any problem with private credit.
Yeah.
I actually think it's exciting.
Yeah.
It's
dynamic.
It's dynamic.
It meets the business where it is. Yeah, I agree.
And the strength of the U.S. financial system is the depth and now the breadth. But you could see that what's happened, that so much lending is being pushed outside the regulated banking system, that tells you it's overregulated.
Right. Yeah.
Right. So now, one test will be, how has bank lending, especially small regional, small banks, community banks, come undone? And these small banks, the small banks and community banks, they're 70% of ag loans.
Right.
They're 40% of small business loans.
Yeah.
And that's one of the reasons Main Street's been stifled.
So can you talk about then how you will work with the Fed in sort of the change of all of this financial machinery?
You need to. And do you need to work with Congress too to make these changes?
And also just generally maybe your thoughts on just the Fed in this process of help or foe, like where do they stand?
Well, the Fed, I 100% support the Fed's autonomy in monetary policy.
Yeah.
I don't agree with it all the time, but
right.
That's
how it is.
It's how it is. It's how it is. And and I said I won't comment on prospective policy. I can talk about their mistakes in the past, which have been numerous. But I think, like with any system, as it expands beyond sort of the core, I actually think that some of the things they've done in regulation, some of the things they've done in kind of climate and DEI, some of the things maybe even non-standard monetary policy. threatens their independence. And I want them to stay strong, robust, and independent on monetary policy. On regulation, I think that they have been much too harsh on especially the smaller banks, medium banks. So there's three main bank regulators. There's the Fed, Office of Controller of the Currency, OCC, and the FDIC. And then there are other regulators, the SEC, CFTC, but the banking regulators at the federal level are those three. Here at Treasury, we have something called FSOC, Financial Stability Oversight Council, and I chair that. And via that, the President's Working Group, which is another convening mechanism that I plan to just keep pushing for safe, sound, and smart deregulation. Like, why are we doing this? Why are we doing that? And again, that there's a capital charge to banks for buying Treasury bills.
Totally. Right.
So I actually think there's a chance that if we take, it's called the supplementary leverage ratio. If we take that away, it becomes a binding constraint on banks. We might actually pull Treasury bill yields down by 30 to 70 basis points. Every basis point is $1 billion a year.
Can we talk about that for a second?
Yeah.
So I think, and I've said this for a year probably, but one of the biggest mistakes that I think Janet Yellen affected was this continued issuance of money on the short end of the curve to finance these deficits, which gives you inherit an incredibly difficult challenge, I think, over the next 9 months. I think there's like 9 or 10 trillion that has to get refinanced. Do you want to talk about that?
Yeah, look, I thought that when rates were low, you're supposed to term out rates.
Exactly.
And instead, the Treasury for the past few years has pulled rates in, and I think part of that was to keep rates lower. That they changed the issuance schedule when rates moved back up towards 5%. I have maintained that policy, but I'm maintaining it because, let's go back to David's question of when are we going to see the results from this, getting the government spending under control? And I don't think the markets recognize it yet.
Yeah.
Like again, if we
they're not sure what to believe. I mean, we hear this commentary a lot. Like, there's just a lot of uncertainty. There's a big spectrum of opinions there.
Yeah, like the central value tendency, you're right, the central value tendency, like what's the center of it? Because the range of outcomes is so broad. And like we know there's a problem there. We know there's waste, fraud, and abuse. Quantify it. So I think as we are more able to quantify it, we will get credit for it.
So let me go back. So outside of waste, fraud, and abuse, as it's termed, I want to go back to the question I asked earlier. How much does this administration need Congress to act to get to 3 to 3.5% deficit to GDP? And what's your read on the Congress and how willing and able they are to take the action that's needed here?
Yeah, I think there are a lot of headlines, especially after the CR, about the Democrats being in disarray, and media likes to write about disarray.
Mm-hmm.
I think the untold story here is Republicans have, for a change, actually been very disciplined. And I think a lot of that, President Trump is kind of shepherding the party, shepherding the movement. Because imagine, he said, that Mike Johnson will never get reconciliation instructions out of, he's got such a slim majority. Well, he did it.
He did it. Yeah.
That he'll never be able to pass a clean CR. He did it.
He did it.
So let's see what happens with the budget. So we need Congress to be our partners on the budget. They're very engaged, the House and the Senate. That everybody recognizes that if we don't get this done, it's going to be the biggest, it's pass-fail. It's the biggest tax hike in history.
Where does DOGE come in?
Well, Doge, that's the cost cutting. And it's the first time we've really ever had business people looking at it.
Right.
This Clinton-Gore commission that we hear a lot or hear a lot about, I think it was a bunch of business school professors.
But here you've got real CEOs. You got Lutnick, you got Burgum, you got Elon. I mean, this cabinet is stocked full of experienced operators that can go in and identify where there's an opportunity for saving the taxpayers' money and still getting the results.
Well, it's that. And we had this crypto council meeting the other day, and I was sitting and looking. It was myself, Secretary Lutnick, and Kelly Loeffler. Everybody was a market person. Like, forget business.
Yeah.
Like, but with Doge, that I am completely aligned with what Elon's doing. And everyone says, well, do you have to do it so fast? Do you have to do it? Like I said, I've only been in this business for 7 weeks. I've only been in DC for 8 weeks. But the thing I can tell you is if you don't move fast, the vested interest will weigh you down.
Totally.
Like the quicksand will come up, or
the claws get
the claw. Yeah, everybody's got lobbyists. Everybody's got.
Yeah.
I mean, think about it. Within a 10-mile radius of here, 25% of the GDP of the U.S. pulsates through here.
Pulsates
every day.
Yeah.
And everybody wants to just skim a little. I said to Elon, we were in a meeting, and I said, people are mad at you because you're moving their cheese. And he goes, it's not their cheese, it's the American people's cheese.
100%. Right. Every dollar spent goes into someone's pocket, and that person's going to fight tooth and nail to get that dollar to keep flowing into their pocket. And it's a very, like, there's no winning in Elon's role. There's every single time he takes action, there are people that are going to come after him, that are going to come after the administration. There's no and obviously gets recast, reclassified in the media as being something different, but there's nothing but downside as you make these changes to individual organizations that participate. And then it takes a while for the flow of that money to find its way, or those individuals to find their way back into the productive private economy. That's where I think there's a big gap and a big challenge in the perception of the actions that are going on with the changes right now, is everyone sees the cuts, but they don't see the benefits. And that's 9 months, 12 months, 15 months down the road. And that's a really hard thing to reconcile for most.
Yeah, and I'd say there are a couple of things too. Is one, like, everyone's hearing cuts and they think their government services are going to get cut.
That's right.
And they're not. I keep saying it's the Department of Government Efficiency, not government extinction, not government elimination. Right. And can we make it run much better with fewer people, with fewer costs? And I don't want to demonize any of these federal employees, because I tell you, in this building, I've been so impressed with the quality of the people. I would have hired them in my private firm. They are great public servants. I need you to stay for the weekend. I need a 25-page memo in 72 hours. Super high quality. I actually think when all this is done, there will have been two big savings. One will have been on these contractors.
Sure.
Which
we were just talking about this.
We were with Elon just now.
We were just with Elon in the West Wing.
An incredible stat. He said, I'm not going to name the firm so that I don't want to, but he said this one organization gets 98% of their revenue from
it was in the newspaper, so we can say it. It's Booz Allen.
Exactly. So we were talking about this, and then we were going through the numbers on the other firms, and it's just the whole thing.
It's shocking.
What kind of risk management is that, by the way?
Yeah.
Right.
But it tells you that they didn't manage the risk.
That's right.
Tells you how entrenched they believe they were,
and how good it is for them,
and how good it is.
You're absolutely right.
And the way the grift works, you can only have 6-month contracts, but there are people who have had 40 6-month contracts.
Incredible.
Like, they've been in situ for 20 years.
Incredible.
And it's this whole.
I'm so happy there is transparency and visibility into this. If for nothing else, the administration providing this level of insight and data, I think, is so important for taxpayers and individuals in this country to see, to recognize, and importantly to understand just how much of this grift is going on. It's frightening, and I'm glad that it's being addressed.
The American people can see if they want it.